No sé, autores.
Amiga, poco creo que
¿Hay un programa de ustedes o no? Sí. Entonces dura 1 hora. ¿Hay alguien que no hable castellano acá? No, pero las caras. El único que no habla inglés es alguien que no viene, que no está. ¿Qué hora es? 10:30. Estamos un minuto tarde. Bueno, bienvenidos a todos a esto que es la 9ª conferencia anual UTDT. Ahora tenemos un programa que empieza con 2 papers de deuda soberana. El primero lo va a dar Gastón Chaumont, ¿cómo se dice? Sobre lo que dice ahí. Entonces, 1 hora, y como no hay comentarista, estilo seminario y la gente te puede interrumpir.
Buenísimo.
Y vos le puedes decir que cállate la boca.
Bien. Bueno, gracias a los organizadores por poner el paper en el programa. Me encanta venir acá, así que estoy contento de presentar este paper que es con Greg Gordon, Bruno Sultan y Elliot Tobin. Greg y Bruno son de la Richmond Fed, así que los disclaimer apply. Y el paper del que voy a hablar es de default risk y credit default swaps. Y voy a hablar un poco del rol de los intermediarios en la provisión de liquidez y de insurance contra default risk. Me va a pasar en inglés, porque me sale más fácil, porque por la duda que venga Ali, ¿no? All right, so the main thing we're after in this paper is how does the CDS market affect the sovereign default bonds prices? So the CDS are the credit default swaps are insurance against default risk. So this is basically a very simple contract where a seller of an insurance provides a buyer with insurance against default risk. So if there is a default, the buyer gets repaid or gets compensated for the loss of the default event. And sovereign CDS in particular, or CDS associated to sovereign debt or default risk, are large in volume in spite of being traded in these decentralized markets that are known as over-the-counter markets, where transactions are bilateral between 2 parties that want to trade in opposite directions. And these instruments are widely used to reallocate credit risk between different types of investors in the economy. But despite having like good models to understand how this credit default swap market interact with the bond market, we still see that policymakers regulate the markets for CDS, and it's not so clear why we should regulate or in which direction we should regulate these credit default swap markets in order to affect the bond market in a specific way. So we're going to try to understand what are the interactions between the markets for credit default swaps and the bond market. So more precisely, what we're going to be after is how is the CDS or how are CDS and bonds used to reallocate credit risk among different participants in the market, among different types of investors. And in particular, we're going to be focusing on the role of trading frictions in over-the-counter markets. And then we're going to try to understand how is the sovereign bond market affected by the existence of an insurance against default risks. So we are going to check or try to see how bond prices respond to the existence of an insurance market and what are the implications for sovereign debt management and default risk, and whether we should regulate the CDS or the bond market in a specific way to improve the bond market in some ways. So if you think of a world where markets are perfectly competitive and there are no frictions, information frictions or trading friction or anything like that, the CDS market should be irrelevant because you could basically trade risk-free assets and bonds in such a way that the CDS market doesn't matter at all. You're basically allocating default risk into your portfolio, either by using bonds or CDS. It shouldn't matter how you do it. So we're going to argue that the reason why these two markets, the market for insurance and the market for bonds, have some interactions is because there are two main frictions in this market. The first frictions are going to be trading frictions, and the second frictions are going to be regulations that are going to constrain the allocations of bonds and CDS that people can hold in their portfolios. So trading frictions are going to come from the fact that bonds and CDS are traded in over-the-counter markets. So here transactions are bilateral. So if you want to purchase a bond or an insurance against default risk, you have to go and see a banker that sells you that particular asset, and the banker must have it in the inventory or find it somewhere else. CDS can be created by large banks, so they could create the contract for you. And then we don't know whether how these interactions between bond and CDS are going to end up affecting the price of the bonds. And there are arguments in favor or against the CDS market in the following sense. Some people say that the existence of an insurance market against default risk is going to increase the demand for bonds and actually increase the price of the bond, because now investors feel that they can hedge against the default risk when they hold the bonds. So the availability of this insurance is going to attract more investors to buy bonds, because then they can purchase insurance, and then that will attract more investors to buy bonds and increase the demand for bonds and the price for bonds. But then,
how is that? If you buy the two, you're buying a risk-free bond. It's like a treasury.
Right, you could adjust your position.
So essentially, there is somebody else that is taking the sovereign risk that is the issuer of the CDS.
Right.
It has to be the same.
Well, if the markets were frictionless and there was no differences in prices, or these frictions had no impact on prices and everything was perfectly competitive, it would be the same. But we're going to argue that trading frictions and regulations are going to create demand for the two assets. And then there is some people that say, okay, if you buy a bond, then you get exposed to default risk, but you can undo that part of that exposure, or you can hedge against the default risk by buying CDS, and that has a positive effect on the demand for bonds because it attracts more investors. And then there are also people that argue that actually the CDS are bad for the bond market, because you can reproduce a bond or create a synthetic bond by the right amount of a risk-free asset and a CDS. For example, if I want to buy a bond, instead I can buy a risk-free asset and sell a CDS in the right amount, so that the payoff are exactly the same as what a bond would do. So then
so what is the experiment here? You introduce a CDS and you see how prices change when you introduce a new asset.
Right. So we're going to ask whether having a CDS market is going to increase the price of the bond, or it's going to reduce the price of the bond that the government can get for issuing.
And the CDS is a redundant asset because you can do the synthetic with the sovereign bond and the treasury.
It could be a redundant asset, but we're going to argue it is not. It actually affects the price of the bond because there are trading frictions and there are portfolio restrictions. I'm going to be more clear about that. But yeah, then there is these people that argue that actually, if we allow for CDS, the price of the bond will go down because we can substitute the bonds for synthetic bonds, create this alternative asset, and then we don't need to go and purchase bonds, and the demand for bonds is going to go down. So whether this CDS market is going to be a complement or a substitute for bonds, we're going to check that quantitatively. And then the other reason why the CDS market is going to play a role here is because there are regulatory constraints that affect the allocation of bonds and CDS that you can hold in your portfolio. For example, in some markets, you cannot short sale sovereign bonds, so the CDS might help you do the same the transaction in the same direction. Or in Europe, for example, the CDS are restricted in some way. For example, you cannot hold insurance if you don't hold the bond. So in order to be able to purchase insurance, you can only do it if you hold the bond. You couldn't buy insurance speculating that there is going to be a default risk to make some money out of that bet. So those constraints in the portfolio are going to make people choose different amounts of the two assets to achieve the desired exposure to default risk. And then we're going to check whether these regulations are actually affecting the prices of the bonds strongly or not. So let me try to be a little bit more clear of what we do here. So basically, we're going to write down a model where there is sovereign bonds and default risk, and we're going to incorporate the credit default swap market. And both the bonds and the CDS are going to be traded in over-the-counter markets. We're going to model that using search frictions in the markets for bonds and CDS. And then there are going to be large investors, which are going to be intermediaries. We're going to call them dealers, and smaller investors that we're going to call investors. And these guys are going to try to maximize some return risk kind of preference, and they want to maximize the return, but they don't like risk, and they will have different capacity to hedge or to bear the risk, and they are going to have in the end different preferred allocations of or exposure to default risk. Then we're going to take the model and try to quantify the role of trading frictions in bond prices and how sovereign bonds price are affected by the existence of this insurance market. And then we're going to play with the constraints that we impose on the quantities that you can have of bonds and insurance credit default swap in your portfolio. So we're going to allow for bond short selling. We're going to do what Europe did, which is buying naked CDS. Basically, you cannot buy insurance if you don't have the bonds, or if you're not exposed to the default risk. And then we're going to shut down CDS completely and see what's better for the bond prices.
Hey, Gastón, so this assumption of the OTC market, it holds more for countries for which the CDS market is itself thinner, right? So if it's a sort of a very marginal emerging economy, I will expect that the CDS market for those bonds is thinner. So and I can also think that the market for the bonds themselves look like OTC, but as the economy is a bit more developed, the market for the bond looks less and doesn't look like OTC that much, right? You will expect that the CDS market, those bonds that don't look like OTC, is also bigger. Am I wrong?
I'm not exactly sure what you're saying, but both bonds and credit default swaps are traded bilaterally in over-the-counter markets. Usually they are not traded in exchange market like stocks, for example, in a centralized market. So basically, you trade with a counterparty bilaterally, even though there are platforms to do so, or you can go to the bank, but still it's bilateral transactions, and there are fees involved in those transactions too. So that's what I mean by over-the-counter market.
There's a fee. That's the way it happens.
Oh, there's a fee and there's a bilateral transaction. And if you want to get a bond, actually it has to actually hold it to give it to you. You cannot go to a centralized market where a lot of bonds are being traded and you find something immediately there. You trade with someone else, and that someone else has to hold a bond inventory or find it for you.
That we're arguing that is a good description of the data. I understand that that's a description of the model, but is that
in the data too, in reality too. Yeah. So let me tell you a little bit of the findings that we get here. So about the role of trading frictions, we're going to find that if markets were perfectly competitive for bonds and CDS, instead of being frictional and trading over the counter markets, the price of the bonds will be higher and the spread will be 27% smaller. So instead of being on average 9% for Argentina, they will be 7%. That's what I mean with that number. And the liquidity is going to worsen when we're closer to a debt crisis. So the liquidity premium that these bonds are paying is going to be more expensive when the default probability is larger.
Which were those trading frictions? That's a lot. That's a huge fraction.
Yeah, so this is basically the fact that you have to pay intermediation fees to create transactions. If we eliminated that and the markets were perfectly competitive.
What about other markets? Because you have a lot of that kind of transactions are in other markets. Is that the same?
Well, most of the transactions of sovereign bonds and CS are happening bilaterally in over-the-counter markets.
Yeah, but that's a feature for other transactions of other facets.
Right. Well, so are you asking me if I was looking at the different assets, I would get.
No, yeah. This is particular for this kind of bonds, or?
I don't know. We estimated with data for bonds. I have no idea what will happen.
No, Gastón, all bonds are traded over the counter.
Yeah, most bonds. Yes. I mean,
So
That's what I mean.
yeah.
So people trade bonds of like Ford Motor Corporation. Why isn't it the same? Is it because they are more liquid? What's the difference between the over-the-counter market for a corporate bond and a similarly rated sovereign bond?
No, they work the same way. Then probably in corporate bonds, there are other issues that are more salient. For example, informational frictions for corporate bonds may be more salient than in sovereign bonds because you have to understand a lot better the company and the financial situation of the company, and there might be investors with different valuations and other stuff going on there. We believe that for sovereign bonds, this is cleaner and the spreads, the trading frictions and the fees that are paid there are more reflecting the transaction cost than other stuff. But the way the markets work is exactly the same.
Yeah, so maybe you will want to check if these numbers that you get for the lower price of the bond because of the trading friction are consistent with what people think
Right.
happens for other bonds.
Right.
Amen.
Yeah.
That's a huge.
Yeah, no, I agree. And let me say that the numbers that I'm going to show you today are preliminary because we are incorporating more data into the calibration and they may change, but this is what we find for now. Yeah, so basically about the role of CDS, if they increase or reduce the price of the bond, this is going to depend on the state of the economy and the calibration of the model. So if we change the parameters or we change the state of the economy, it might be that shutting down CDS actually increase the price of bonds or reduce the price of bonds. And then we play with regulation and relative to a benchmark where you cannot short sell bonds and there are CDS available in the market. We are going to find that if we allow investors to short sell bonds, the price of the bond is going to actually go up, which is a little bit counterintuitive because you are letting investors create bonds by increasing the supply by short selling bonds. But even though the supply is increasing, the price of the bond is going up. And this is going to be because, I'll show you the explanation later, but basically the market is going to become more efficient in allocating the risk and the risk premium is going to go down in some way, but it's very hard to see without the model. And then we see that if naked CDS are banned, as Europe did, the price of bonds, you can think of Greek bonds or any European bond, we should observe that they increase. But if you completely shut down the CDS market, the bonds are actually going to go down on average. About what we contribute here to the literature on sovereign default and over-the-counter markets is basically we are proposing a model where the CDS matter due to trading friction regulation. We provide some new evidence on risk allocation that is going to be useful to quantify the trading frictions. And then we measure the effect of regulatory changes on the price of the bonds. So let me show you some data and empirical facts about the bond market and the CDS market, and then I'll show you a model and the results. So about the data, we have this regulatory data for the CDS that ranges from January 2013 to July 2018 for 49 countries. And we have transaction level data on sovereign CDS coming from this DTCC. we basically we aggregate it monthly, but basically we have at the transaction level, the price that is paid for a CDS and the volumes. So we can actually see the transaction fees and everything for each CDS transaction. We also observe bond yields and CDS spreads, and we have this measure of how liquid the bonds and the CDS are, which are the bid-ask spread, basically the difference of the price that you get to acquire one of these assets minus the price that you get if you resell the price, resell the asset divided by the average of the two. So basically we can see quantities traded, prices, and we can see at the firm level, at the bank level, the position of CDS that they hold. We're putting that together with another data set that the Federal Reserve has that allows us to see also the position of bond holding. So when we put all that data together, we are going to be able to see exactly how the large banks regulated by the Federal Reserve are exposed to a default risk from different countries and how they are exposing themselves using bonds and CDS. For now, what I'm going to show you is coming more from the CDS part because we just got access to the other data.
So just institutional question.
Yeah.
This is an over-the-counter market.
Yeah.
But all the transactions that are done bilaterally are cleared through a centralized exchange.
Some of them, but even if they are traded bilaterally, the Fed asks this regulating institution to report all their transactions, so they have to give the information to the Fed, and that's why we see it. But it's very hard to find data on bilateral transactions.
No, that's why I'm
Yeah.
asking the question, because you would think that in this over-the-counter market, it's very difficult to have transaction level data because it's private and they don't have, its parties don't have to report it or they don't have any reason to tell you.
Right.
So what you're saying is like in some way the back office is the same for everybody, and that's where you see the.
No, I'm saying that the Fed obliges this institution, the banks, JP Morgan, Goldman Sachs, and everybody to report their bilateral transactions. So all the institutions that are regulated by the Fed or anyone that trades with a regulated institution is going to get recorded because by regulation they have to report their transactions. So that's why we see it. But it's not that happens everywhere, and you could observe the transactions.
All the transactions are done through a market maker, through one of these regulated brokers.
Well, I'm going to show you now, yeah, but let me show you. So this is the first fact that I want to show you, that we're going to divide the participants of the market into two types, investors and dealers. Dealers are the big banks, Goldman Sachs, Morgan Stanley, and all those guys. The data set comes with their own definition of what a dealer is. We have checked, like looking at the 10 biggest players of the market and so on, calling them dealers, we see the same stuff. So basically, 96% of all the transactions happen through the hands of these big banks, of these intermediaries. Like 1/3 of that 96% is coming from transactions between dealers, and the other 2/3 are transactions involving a smaller investor and a dealer in the opposite directions. In one, we have investors buying from dealers, buying from investors, and investors buying from dealers, and this is 1/3 each. Bilateral transactions between smaller investors that are not these top 10 or top 14 players in the market are very small. It's just 4% of all the transactions. So most of the transactions are intermediated, and we're going to make a model that actually reflects that.
So that is saying that if two hedge funds trade between themselves, you see that because that's the 4%.
Right. Some of them will be regulated, and yeah, we see them. Yeah, and there are just a few transactions. Yeah. The other thing I want to tell you about this CDS market is how the big players react when there is a larger probability of default risk. How are they responding in terms of providing or getting insured when the probability of a default is larger? So what we see here is that the dealers play an important role in providing insurance when the probability of a default is larger. So when the probability of a default goes up in these 49 countries, we see that dealers end up selling more CDS, selling insurance, so they get more exposed to the probability of a default, and they provide more insurance to the smaller players in the market. They also play an important role in providing liquidity to the market when there is a higher probability of a default, because we see that as the yields of the bonds is going up, or the probability of default is increasing, these intermediaries not only sell more insurance, but they are buying more CDS also in the CDS market. So they are intermediating more transactions. They are getting more, they are buying more CDS, but they are also selling more CDS. So they are intermediating a lot more transactions when the probability of default is going up. And the last fact I want to show you is this relationship between the probability of a default and the liquidity in this over-the-counter market. This is a picture for the CDS market, but the same thing could be seen for the bond market. And basically, this is showing that as the yield or the probability of default is increasing in the horizontal axis from 0% to 40%, the bid-ask spread, or this gap between the price that you pay to buy an asset and what you get if you resell the asset, which is basically what you pay in intermediation fees, is increasing, it's going up. So look at the numbers also. This bid-ask spread can be very large when the probability of default is large. This is a 500 basis point, or you are paying 5% of your investment in intermediation fees when the probability of default is about 35%. And something similar happens.
So the units in the horizontal axis are
Probability of default in 1 year.
it's a probability of default.
Right. So yeah, we take the asset prices and translate it into the probability of default from now to a year, in a year from now.
No, and then and if you do the bid-ask spread as a ratio of the price,
Oh, this is as a ratio of the price. So this is the price.
This is in basis points.
Right. This is the price you pay minus the price you will get if you resell, divided by the mean price, the average of the two prices.
Okay.
So it's proportional to the value of one unit of the asset, how much you're paying in termination.
Okay. It's amazingly steep.
Yeah, and all from 20 and above, and maybe from 10 and above, is just transactions in CDS markets for Argentina, Ukraine, and Venezuela. That's it.
And presumably the liquidity of that is very, very small.
Right, it gets a lot more expensive to trade. Like you're paying up to 5% of your capital.
Because there are very few people that want to.
Right, nobody wants to trade those assets. Exactly. Yeah, at 40%, you see some 1,000% basis points there. Okay, so let me summarize what I just showed you. So basically, we see that the CDS market is highly intermediated by dealers. 96% of the transactions go through the hands of the 10 or 14 biggest banks in the market. Dealers are actually net sellers of CDS. They are insurers of the rest of the economy, and they insure them even more when the probability of a default is even larger. Not only they are providing insurance, but they are also providing liquidity when the probability of default is larger, because they are intermediating more transactions. And also we see that for bonds and for CDS, this liquidity measure of the bid-ask spread or the intermediation fees that are paid are increasing in the probability of default. So we will construct a model that has all those features into it, and then we're going to use this data only for Argentina to calibrate the model and try to answer the questions that I showed you in the beginning.
Hey, Gastón,
Yeah.
one last question over there. If you show us the plot again, if in this plot you size the dots by the transactions, what would it be? Like huge sizes here on the left, right?
I guess because most countries are here.
Exactly. Most countries are this
Yeah.
one, what I had in mind in my previous question.
Right, and then
Most countries, actually this version.
right, most transactions are happening here. There are some point in time and bonds, mainly Argentine, Venezuelan, and Ukrainian bonds that are around 10%, and they are less traded, and they pay higher intermediation fee. So yeah, probably that would be informative of the volume, so I could do that. Yeah. Okay, so let me try to go through the model. How much time I have left? Like half an hour. Okay, I'll try to go quickly through the model so that I have time to present some results. But please stop me if something is very confusing because it might get a little involved. This is a sovereign default model, very simple. You can think of Arellano's model of 2008, and it's going to be exactly the same. You have a government with an endowment that follows an AR1 process and some stock of debt that it has to repay today. This is short-term debt. And the government decides whether to repay fully or default by choosing delta equal to 1, that means default. If the government defaults, the usual punishments are applied to this economy. The endowment goes down by some fraction, there is an output loss, and the government gets excluded from financial market temporarily, so there is an exogenous probability of coming back to the market with no debt. Now, if you decide to repay, you can choose how much debt to issue today in order to maximize the current utility from consumption of the representative household, and you have the continuation value of having the option to default in the next period. And consumption today is going to be given by the endowment plus the revenues from issuing new debt. This is the price of new debt times the amount you issue minus the amount of debt that you have to repay. This is super standard sovereign default model. The only difference here that is going to appear in the end is the price of the bond that we calculate, because this price is going to reflect all these trading frictions, not only in the bond market, but in the CDS market, and it's going to affect the willingness to pay by investors when the government is auctioning new bonds.
There is a default.
When there is
no recovery value for the insurer or the bondholder.
Here we are saying that there is zero recovery value. So if you hold the bond, you lose all your money, but the issuer of the CDS is going to repay fully for your loss. I think
so the issuer of the CDS
has to pay.
That doesn't have any bargaining, but it doesn't get anything from the country,
right?
Because typically they insure the bond, they keep the bond, and then they recover part of the loss, right?
Right. So in reality, what happens is that when there is a default, I mean, there is some institution that declares the great event and a default, and then what happens is that they take the bonds that are outstanding in the market and they make a new auction, and then from that new auction of the defaulted bonds, they get the price, the market price for those bonds. So that's the recovery value that you will get. Yeah. And then the seller of the insurance will cover the remaining of the face value that is not covered by the market price. Here we are saying the recovery is zero, and the insurer has to pay everything, but we could adjust that very easily.
No, but when you look at the spreads,
yeah,
the spreads have to depend a lot on what is the recovery value.
Oh, but
in the data,
we're basically kind of controlling for that part in some sense. We are removing that part and we are pricing. So the price of the insurance is going to depend on the expected recovery value, right? So
yeah.
So we are saying how much you're paying for each unit of loss, or that's the way we're measuring it in the data. So we are cleaning that part.
But I don't understand how do you know the recovery value to figure.
Well, they have expectations, I think, in the contract of the recovery value or something like that. I don't remember exactly now how that is measured, but the CS contracts are very standardized, and I think there is a very clean way. I had the same question at some point. I understood it well, but now I'm a little confused. But you can basically clean all that part, and this is either. Yeah, I would probably need to recheck that to give you a precise answer, but we can actually clean for that.
Because in general, the problem when you have to value these things or compute the spread is that for these bonds that are in distress, and the probability of default is like 40%, you were showing there. The value of the bond depends to a large degree on the recovery value, that is the price that the fund of the lawyers and the vulture funds are willing to pay that might not be the same for each country.
No, I agree.
That might vary. So then it's very, so pricing, it's very difficult for me to think of a model that wants to explain something like that, that doesn't address the question of the recovery values.
Right. So no, no, I agree with you, and that's some concern that we have when we were understanding the data. But I cannot come up with the details now, but we actually clean for that. So we can either see in the contract the expected recovery rate. So there is an expected recovery rate when you sign the contract and you pay the price, or something similar to that, but we can clean for that part. So whatever I showed you before is assuming like there is a zero recovery in there. And the expectations might be wrong, and probably the price are not exactly reflecting what you get in the end. But I think there is the contracts come with some expected recovery rate, and the price is associated to that. And yeah, unfortunately, I don't remember the exact detail now, but it's like the things that I showed you before is removing that and assuming that there is zero recovery. So I'll call you that.
Now, we can talk about this later, but I'm very skeptical that is time invariant. If you look at Ecuadorian bonds, they have to be contingent on the price of oil that moves all the time.
Yeah, I mean, let me refer to that question because I'm not going to be able to say something very smart now. So, but I'll probably check that for you and get back to you later. Okay, so that's the default model. And then we have this OTC block of the model, which is the secondary market for bonds and the market for CDS, which is over the counter. So we will have a kind of a two-period structure in this part of the model. There are going to be these investors and dealers that are going to be trading bonds and CDS. And basically, for them, the supply of new bonds, B prime, and the probability of default, they take it as exogenous. I mean, they take it as given. Then, of course, in the model is endogenous and decided by the government. There are three assets in the model. There is a risk-free asset, which is a perfectly elastic supply. So anyone can trade a risk-free bond at the risk-free price in a valuation market. There is a sovereign bond and there is a CDS, and these two are trading over the counter market. Now, the market participants are dealers and investors, and they will have different technologies to trade and different preferences. So dealers are going to be risk averse, but they have access to an inter-dealer market, which is valuation. So between them, they can trade you can think perfectly competitive markets and adjust their position as much as they want without intermediation fees. But when they trade with the smaller investors, hedge funds, pension funds, and so on, they have to go to the over-the-counter market, and they will charge this smaller investor in the transaction fee.
Both ways, right? Both ways.
Right, they buy and
sell, and when they buy, they charge.
They charge, yes. And then there are risk-averse investors, hedge funds, pension funds, that can only trade bonds and CDS in this decentralized over-the-counter market. And to model this decentralized markets, we're going to use directed search. So basically, there are going to be a continuum of some markets where you could trade bonds and another continuum of some markets where you could trade CDS. And basically, what dealers and investors are choosing is the intermediation fees that they want to charge or pay in order to create a transaction. And that will come with some probability of trading that is going to be endogenous to the intermediation fee. So I'll show you how it works in a second. So the dealers here are going to be maximizing this two-period profits function, which depends on their portfolio composition of risk-free asset, bonds, and CDS. So they can trade in this valuation markets, the inter-dealer market, and they will be paying QF for the risk-free asset, Q for the bonds, and P for each CDS that they trade, and the utility is linear in the first period. But they don't like risk, and they will have concave utility in the second period. So the return in the second period is going to be given by this utility function that is going to represent risk aversion. If there is no default, they will get paid by the risk-free asset and the bond. And if there is default, they get paid by the risk-free asset and the CDS. And then the regulatory constraints are going to be basically affecting some restrictions that we are going to be imposing in the quantities that you can trade. For example, if we ban bond short selling, the lower bound of bond holdings is going to be 0. And if we don't allow for naked CDS, the difference between bonds and CDS has to be non-negative, and so on. So this is how we're going to play with regulation. Now, let me say also that the price of the bond in this interdealer market is going to be also the price of the bond that the government receives upon issuing new bonds. So you can think of the government selling the bonds into this interdealer market, or selling the bonds directly to this large player, which is actually what happens in auctions. You got a question about that?
Yeah, don't they have a budget constraint?
These guys? No, in the first period they can pay. Well, let me talk about that. But yeah, we're going to assume that in the first period they just suffer this utility in dollars for each dollar that they pay, and then they get a return, but they don't like risk. So they are not.
It will explode their budget, their balance sheets. It could be as such.
Yeah, they could trade as much as they want for now. Yeah. Okay, so to trade with investors, these individuals, in order to be able to have this high profit, they have to either enter the bond or the CDS market. And to enter the bond market, they pay a fee, an entry cost gamma B or an entry cost gamma C for the CDS. So the expected profit of entering some submarket is going to be given by this capital pi of the transaction fee that they choose. So this is the directed search part. They are choosing how much intermediation fee to charge if they trade. So if they enter, they will get the profits from being active in some of the markets. So they get access to the interdealer market and get this profit, but they pay the entry cost to the bond or the CDS market. They could be different. And then they also get the expected revenues from trading in the over-the-counter market, which is the probability of trading times the intermediation fee that they charge. So there's going to be free entry of investors into these markets. And then in all the submarkets that are active, this profit, this capital pi has to be equal to 0. So that will generate a trade-off between the probability of trading and the intermediation fees. So if this has to be equal to 0, this is constant. If you want a higher probability of trading as a dealer, you will have to charge a lower intermediation fee. You have to access the submarket where you charge a lower intermediation fee. But if you charge a high intermediation fee, you will find less investors willing to pay that intermediation fee, and then you will have a lower probability of trading. The mass of investors that are going to be entering is going to be endogenous. It's going to depend on the profits because this has to be equal to 0. So the total mass D of dealers is going to be important here to determine the fees, but also and the probability, but also to determine how many people is trading in the interdealer market. So the more people that is trading in this interdealer market, the more dealers that are available, the better they can share the risk because they can freely readjust their portfolio in the interdealer market. So a dealer comes, get exposed to default risk either through bonds or CS transactions, then they can meet with other dealers that didn't trade with investors and rebalance their portfolio and have the same exposure and have a better hedge of the probability of default. So this possibility of resharing with more people is going to reduce the marginal risk aversion of a dealer, and then that's going to reduce the risk premium that bonds are paying. So more dealers active in the market is good for the economy. The investors are going to be trading in these over-the-counter markets sequentially. We have played with the timing and it doesn't matter much. So we are going to stick with this sequential version. So first, they try to go and buy bonds. So to do that, they choose how much intermediation fee they want to pay. And with that, they have a higher or lower probability of trading. So if they are willing to pay more intermediation fees, they are going to visit some markets with more dealers because larger intermediation fee attract more dealers and they will face a probability of trading that is higher. If they are paying lower intermediation fees, they trade with lower probability. And then they choose how much to trade if they meet someone. Then after trying to trade bonds, they will try to trade CDS in the CDS market, and then in the end, they will choose their position in the risk-free asset. So, sorry? Okay. Let me brush a little bit with the rest of the model. So after trading, the utility is going to be very similar to the ones of the dealers. They will pay the prices conditional on trading, but also they pay the intermediation fees if they trade. And then the second period, they also have a concave utility, and it's similar to the dealers, but they will have different preferences. So we will allow for different risk aversion, and we will estimate that with the data. The only difference here is that we will have this extra omega term in the case of no default. Basically, because this will allow us to match the net exposure of dealers relative to investors in the data. And you can think of this as some other assets in the portfolio of investors that change your desire to get exposed to the probability of a default, or to get exposed in a different way to the state in the economy where there is repayment. Okay. So these are the preferences in each of the steps. So before this is after trade, this is what you get in the end if you trade. But to trade, you have to go to the submarket, choose how much intermediation fee you want to pay, and then you face a probability of trading that is larger if you pay a higher intermediation fee as an investor. And then this omega happens in between. So what we're doing here is that first, when you go to buy bonds, you don't know exactly your exposure to the state in which there is repayment, and then it gets realized before you go to buy CDS. So after trading bonds, you might decide to adjust your position trading CDS. And this is because in the data we observe that people hold both bonds and CDS, but if we don't allow for this shock, they will either trade bonds or CDS because they can achieve the same position with the two instruments. So we'll show that to generate CDS and bonds in the portfolio. And then they trade the risk-free assets. So the market clearing, bonds have to equal, the bond issue has to equal to bond holdings of all market participants, dealers and investors. And then the CDS are in unit supply. So if someone is issuing insurance, someone else is buying it. So some properties of this model, in the interdealer market, the price of the bond price plus the price of the CDS is equal to the risk-free asset. So there is no deviation from what is known as the CDS bond basis. It's the same because it's a perfectly competitive market. But in the over-the-counter markets, when the transaction fees are positive, the price of the CDS is different than the expected or discounted probability of default, and the price of the bond is different than the discounted probability of repayment. So what this is saying is that if you measure default risk either by looking at the CS spread or the bond spread, the two of them are going to be wrong, even with risk neutrality. And this is because there are intermediation fees in the two markets. So none of them can be equal. And then as these transaction fees go to zero, then the price of CDS and bonds actually start reflecting the probability of default and repayment.
Even with risk neutrality, what do you mean by that? So why do you need the risk aversion?
Well, because we don't want to, we want them to care about the exposure to default risk.
Yes.
That's why. But then even if they were risk neutral,
I mean, by the guy's pricing, why the standard assumption is risk neutral. Now you are.
No, I'm allowed for risk aversion because we want a role for the CDS and we want them to care about risk, or else there won't be any role for that. So usually, yeah, the standard model will have no risk aversion. We need risk aversion to care about the probability of default, and we put that in the preferences of the second period.
But what you mean is that with risk aversion, this fee cannot be zero because risk aversion, and
No,
that's a risk neutral pricing, right? P and Q.
Right. So, but even if they were risk neutral,
That's what I don't understand.
yeah, even if they were risk neutral, the prices would be different because they are intermediation fees. So the risk neutral pricing wouldn't show up because you have to also pay intermediation fee. That's what I'm saying. It's not just the probability of default, what is in the price of CDS and bonds.
Okay.
This illiquidity is deviating those prices. All right. And this is what I was saying before, that if we don't allow for these omega shocks, then they either get bonds or CDS and they fully specialize in one of them to get exposed, and they will specialize in the one that they get the chance to trade in the over-the-counter market. One important thing is that the willingness to pay to trade, or how much the intermediation fees they want to pay, will depend on the elasticity of the matching probability to this fee times the gains from trade. This is the value that you get if you trade bonds minus the price minus the value of not trading, and the same for the CDS. So why is this important? Well, because when there is a larger probability of default, these gains from trade are going to be larger. You have more incentive to adjust your portfolio when the probability of a default is larger. And then you're going to be willing to pay more intermediation fee. How much more? Well, it will depend on the properties of this probability of trading, how elastic it is to the intermediation fee, and we are going to calibrate that using data. So let me show you what happens for Argentina.
I got something. These probabilities of trade, the probability that you do a trade depends on what?
On the intermediation fee that you're willing to pay. It's endogenous. Because if you go to a market where you pay high intermediation fees, those are markets that attract more dealers because they are making more revenues for each transaction. And then you are, from the perspective of an investor, it is more likely to trade.
But it depends on the number of people that want to make. How is it influenced by the number of transactions that people want to make?
Not by the bonds.
Yeah, because when you do because you have different ways of achieving it, without the frictions, there is a redemption asset, right?
Mm-hmm.
So when you have 3 assets trading instead of 2, it might be that you reduce the liquidity of each and you make the trading frictions worse. You capture that?
Right. So here, the one way in which the two markets are going to matter in this way is that if you only have the bond market, you can only adjust your position in the bond market. You can only trade in the bond market. So there are going to be only dealers coming to trade in the bond market. If you allow for CDS, there are going to be more dealers in the economy because there are going to be some of them trying to trade in the CDS market. And then if there are more dealers in the economy, they can better share the exposure to default risk across all of them. Each of them has a lower exposure to default risk. And then the risk premium is going that is implicit in the price is going to be smaller. So that's in one way in which the activity of the two markets matter. Okay, so let me show you how we calibrate the liquidity part of the model for Argentinian data. The Argentinian data satisfies all the facts that I showed you before for the 49 countries. So basically we have the entry cost for dealers, the gamma B and gamma C. We're going to use this to match the average bid-ask spread in the data and the model. Basically, the bid-ask spread in the model is the intermediation fee per unit of asset traded. And basically, we're going to target the average bid-ask spread using the entry cost. The more costly is to create transactions, the larger are going to be the intermediation.
5 minutes.
Okay. Then we're going to normalize risk aversion of the investors, the small investors to chew in a CRA utility function, but we are going to estimate the risk aversion of the dealers through direct inference, as well as this investor exposure, exogenous exposure to the state of prepayment and elasticity of the matching technology. Let me show you how that works. So to match the omega, this exogenous exposure of investors, we are going to use as a target this regression, how the net position of CDS of the dealers changes with the yield of the bond. So this omega is going to affect the net exposure. So in the data we observe that dealers are net sellers of CDS. So on average they have a negative position of CDS. So we're going to use this number to match this average, the beta, 0. And then the beta 1 is going to identify the risk preferences of the dealers, because as the probability of default increases, they are going to absorb more of the risk. So the less risk aversion that the dealers have, they are going to be more willing to absorb more of the risk, and that is going to affect the slope of this regression. So we're going to use that parameter from this regression to match the model with the data. So we're going to pin down that dealers are almost risk neutral, but they still have some risk aversion. Very, very small, 0.0 something, instead of 2, which is what the investors have. And then to put the value to elasticity of the matching technology to this intermediation fee, we are going to look at the relationship between the yields and the bid-ask spread. And we are going to observe in the data that as yields go up, the bid-ask spread go up. And the model is going to reproduce that, because as the yield goes up, these gains from trade are larger, and how much more bid-ask spread they are willing to pay is going to depend on this elasticity. So we are going to use this correlation in the data to pin down that elasticity of the matching technology. So let me quickly show you some results. So here we have two cases, the full model that I just showed you, calibrated using that strategy and standard strategy for the other parameters. And then we have an alternative model in which the government is doing exactly the same, but the bonds are all traded in well-rated markets, so there are no transaction fees, and gamma C and gamma B are 0. So in that case, the average spread that we get in the model was 9.7, while in the perfectly liquid markets, we get a 7.6, and that's where the 27% was coming from in the beginning. So the spreads are 27% larger in the benchmark model than in the perfect liquid market. That's how important liquidity frictions are when we calibrate the model using this data. These are the standard dynamics as we approach to an event episode. So GDP is going down and the spreads is going up. The model is reproducing the fact that the dealers are getting more exposed, so their position in CDS is getting more and more negative. They are selling more insurance as the probability of default is larger, and the bid-ask spreads are going up as we approach a default event. Now, the part that I want to close with is how are these interventions or regulations in the quantities of bonds and CDS affect the price of the bond. So we have two cases. One in which the omega is not a shock, it's just a constant value. But let me focus on this one where we have the omega being a shock. And then they want to have both bonds and CDS. So we have three cases. The blue line is the difference between the price in an alternative scenario minus the price in the baseline case, in which there are CDS in the model and we don't allow for short sales of bonds. So here in the blue line, we are allowing for short sales of bonds, and we are seeing that for all level of debt, and we are waiting by the probability of observing each level of output, the price of the bond is going up almost by 5%. So we are allowing people to increase the supply of bond by short selling bonds, but even though we do that, the price of the bond is going up. And this is because this relaxing this constraint of short selling is allowing investors to have larger gains from trade by trading bonds. Now they are less constrained, they can do short selling. Some of them want to do short selling and they are willing to pay higher intermediation fees to short sell. Now, since they are paying higher intermediation fees because they have higher gains from trade, then there are more dealers attracted into this market to trade with these guys because they want to pay higher intermediation fees. And now, since there are more dealers that are buying these short sales, the demand for bonds is increasing. And also, since there are more dealers in the population, then the risk sharing that they can do is better. So the risk premium goes down. So the price of the bond is increasing because in net, the demand is actually going up. The investors are supplying short selling bonds, but then there are a lot of dealers coming in because they want to make profits of these transactions. And then they can also better risk share and the risk premium is actually going down. So we obtain this counterfactual for the counterintuitive result that allowing for short sale actually increases the price of the bond. And then depending on if we shut down naked CDS, we get that when debt is low, we have a positive effect on prices, but when we shut down CDS completely, the prices go down. How am I doing with time? Okay, so let me.
Menos dos.
Okay. Menos dos? No, it's sorry, like 3 minutes late. Okay.
O sea, menos uno.
All right, so let me tell you why banning naked CDS allows prices to go up. This is because when you ban naked CDS, you cannot, investors would like to buy CDS, get insured, but they cannot buy CDS if they would like to, sorry, got confused. So they want to achieve some position or some position, yeah, some exposure to default risk, but now they can only do it by buying bonds. So if you ban the naked CDS, the only way they can get this exposure is by trading in the bond market, and they increase the demand for bonds, and that's why the price of the bonds goes up. But if you fully shut down CDS, you want to under trade bonds because the risk of overexposing is larger than the risk of underexposing to the default risk. So there are two mechanisms going on here. One is the desire to get exposed, and then when you only have bonds but no CDS, no naked CDS, you prefer to buy more bonds because you can undo it with CDS. But when you completely shut down your CDS market, the risk of overexposing is dominating, and you demand less bonds. Okay, let me close. Let me get back. So we argue that CDS are relevant because there are trade restrictions and regulatory constraints, and we developed a model where the CDS matters for those reasons. We calibrated the model to replicate that these provide more net insurance when the default probability is larger, and they provide also more liquidity. Also, we replicate that the asset spread swap with the probability of default, and we quantify the effects of regulatory changes in the bond market and in the CDS market, and we find mixed results. Sometimes the price go up, sometimes the price go down. Sorry for rushing out in the end, but that's it. Thank you for all the questions and the comments.
Okay, so we have 10 minutes. No, thanks to him and to me, we have only 5 minutes for it. Gastón, ¿cómo es el paper de Julieta Salomao? Que te cambia el pelo, cambia el margen después. You have,
Less than an hour.
no, you have an hour. We're going to finish 12:42. I have 2 minutes left for lunch.
Per paper, so we'll see. Well, thanks so much for having me again. It's a pleasure to be here. So this joint work with Juan Carlos Cachondo and Leonardo Martinez. So, Leo is at the IMF, so I have to say these are just our views and not the IMF views, in case you guys are recording. And this is our sovereign debt standstill. Okay, so the motivation is precisely to think through a policy proposal that came as a response to the COVID crisis, and that was that the G20 agreed on extending a sovereign debt standstill to a group of something like 70 of the poorest countries. Okay, and that consisted in essentially a debt service suspension. So these guys will get, if you want, a grace period. But an important part of this is that the proposal is without haircuts. Right? So it's just like kicking the can down. Okay. Later on, after the G20 made this move, there were also other proposals from other groups, precisely pushing private creditors. Right, so this G20 standstill is on official loans, right? So there were other proposals to also include private creditors and to extend this standstill instrument or standstill possibility also not to just the poorest of the countries, but also to include middle income countries. So other proposals sort of enlarge this in terms of who's the creditor that's participating and who are the debtors that are participating. Okay? And in particular, the proposal that became very popular by a large group of economists and lawyers, called the Bolton proposal. So this idea of extending sort of grace periods on the debt payment is also similar to a guiding principle in recent sovereign debt restructurings. And that guiding principle is that to first reprofile the debt before in the restructure. So that bullet point connects me to the next part, that even before the crisis, this reprofiling before doing IMF programs was sort of part of the toolkit. Okay? And there are also, in private bond covenants, or in private bonds, I should say, there are covenants that sort of trigger this sort of standstills if there are some type of liquidity shock. So this is also present in corporate. Okay, so this is the sort of the setting stage, this idea of allowing for these debt suspensions without haircuts as a response to the crisis. Okay, what we're going to do is we want to think about this proposal, and essentially we want to quantify the effects of this proposal. And we want to do that by thinking of a one-time debt relief, which is going to be this standstill, and we want to compare that to alternative measures of debt relief. Okay? And this is going to come after a negative shock. We're going to do this in the simplest environment that we know how to work with, that we think has at least the fundamental elements to capture the trade-offs. So we're going to do it in a sovereign default model that has long-term debt. Okay? What we find is that standstills create.
So what is a standstill in the model?
I'll be very clear, but it's essentially what I said. It's a suspension of debt services for some amount of time.
When you have a negative shock.
Sorry?
If you conditional on a negative.
Conditional on a negative shock, yeah.
Some sort of insurance.
Some sort, yes and no, but I'm gonna explain why no, because I don't solve the full model knowing that the standstill may be triggered by a shock. I just do a one-time event.
¿Cómo funciona lo del no haircut cuando es bonos privados? Yo tengo un bono, me dicen que no que hay un standstill. ¿Qué quiere decir que no hay haircut?
No haircut means no reduction in the face value of your holdings. That's what I mean. The market value may react, and in fact, most of what I am going to talk about is about the reactions in the market value. What we find is that the standstill creates welfare gains for the sovereign, because they enjoy this paying later, but capital losses for the creditors. So this is consistent with the actual observed reluctance of creditors to participate in this proposal. Okay, and suggests that even without a free riding problem, so in the model we won't have a free riding problem. So we suggest that even without that problem, these guys will not be, rushing to participate in this. We also find that doing this standstill creates a sort of debt overhang that I'm gonna be very clear about, and therefore creates opportunities for voluntary debt restructurings or voluntary debt exchanges, which is something that we tackled in the previous paper. Okay. Haircuts, on the other hand, we're going to show that are able to create both gains for the sovereign and the creditor. So in a sense, in a nutshell, what we're finding here is that we are sort of casting doubts on the efficacy of these proposals. There's some literature review, of course, that I'm going to skip. Okay, so that's the sort of setup.
And of course, it doesn't represent the views of the IMF.
And of course, it doesn't represent the views of the IMF. Absolutely, as I said at the beginning, I'm going to repeat now. It's just our views. Francisco Roch is taking notes there to see if I ever say that this is the views of the IMF. Okay, I want to present the model, which is for the benefit, for your benefit and my benefit, is much simpler than Gaston's model. It's a standard stuff in sovereign debt. There's absolutely no novelty here. So we want the standard framework. So a clear default model following Eaton Gersovit and the rest of the people using long-term debt. And the long-term debt is actually important. Okay. So the economy is a small open economy that receives an endowment of a tradable good Y, and that endowment is stochastic. Okay. And the objective of the government is to maximize the utility of a representative consumer, and the utility has the usual shape. Right. So that's the objective. The borrowing opportunities, these guys can borrow vis-a-vis foreign market or foreign lenders who, as opposed to Gaston's model, are going to be completely competitive and risk neutral. Okay, that's the standard stuff. Bonds are perpetuities with geometrically decreasing coupon obligations. So if you've seen this before, you know it already, but if you trade a bond in P and P, then that bond, if you buy a bond in P and P, then that bond pays 1, in T plus 1 minus delta, 1 plus delta square, and so on. For as long as the bond is alive, meaning not defaulted. Okay. So defaults, we're going to assume that the government doesn't have commitment to anything and therefore can walk away on the debt. If the government walks away on the debt, it stops paying any current or future debt obligation. Okay, so it wipes everything out. Okay. So we're assuming total defaults. And a default event starts the period that the government says, I don't pay anymore, and ends with some probability in the future, and that probability is psi. While the government is in default, it cannot borrow. And so there's financial exclusion. So each period the government is in default, it suffers an income loss, which is, this is identical to Gastón stain, this some quadratic loss that depends on the income level. Okay, so that's the standard, our super standard, and all of that in recursive formulation is this. Okay, so a government starts a period with a level of debt B and an income level Y, and it has to decide whether to repay or to default, so this is binary. If the government decides to default, then there's no borrowing, so it becomes hand to mouth. It's just that your income gets reduced. And tomorrow, as I said, there's a probability psi that you get re-access on zero debt, or 1 minus psi that you remain excluded. So that's the value of default. The value of repay, you have to choose debt, and your consumption is your income minus the repayment, plus the proceeds from the issuance of the bond. And the issuance is B prime minus 1 minus delta B, and revenue is that multiplied by the price Q, which of course is endowment. So the price is given by the expected discounted repayment probability, and that thing multiplies the coupon payment, which is 1, and also 1 minus delta of the bond is still alive, and that has a market value given by the price tomorrow. Depends on the optimal choices tomorrow. Okay. So as promised, this is the standard model. We don't do that. Okay. All right. So we're going to take this thing that we know how it works and use it to think about this standstill. Okay. So in terms of calibration, there's nothing new. In fact, we just follow calibration from a previous paper, and where we take the first group of parameters to be standard, and then we calibrate the two parameters that are in the income cost of default in order to hit the mean debt level and the mean spread for some data of that spans like 30 years for Mexico. Okay, so this is just to say that we think it's a reasonable place to it's a reasonable tool to use to think about this stuff. Okay, so we target to 44% debt and 340 basis points the spread. And also the non-targeted moments are relatively light. Okay, go ahead, Carlos.
The income factor is still not lower than the reciprocal of the real interest rate.
It is.
So it's more impatient.
It's more impatient, of course. Yeah. The usual, of course. Good to see about this. Okay, all right. So now to the exercise. Okay, all of that was the setup of where we're going to run the exercise. Now to the exercise. We're going to think of three sizes for the shock. The only shock in the economy is an endowment shock. Okay, so we're going to think of different sizes of income shocks happening at the mean debt level, 44%. So we're going to think of something that, and the way we're going to measure the sizes of the shock is going to be with respect to access to credit as reflected by the spread. So something that we're going to call the small shock is a drop in income such that spread increases by 250 basis points, which is kind of in line with the experience at the beginning of the pandemic in countries like Mexico or in general in other emerging countries, emerging markets that actually preserve market access. Something else, or a larger shock that we're going to call in a very original way, we're going to call the large shock, is one that increases spreads by 1,000 basis points. And with that, we have in mind countries that are that you can call a sub-investment grade. For example, there's an IMF report coming up with a figure that in sub-Saharan Africa, the spreads are at the beginning of the crisis sort of went up by 1,000 basis points. And then we're going to think of a third size of the shock that we call a default triggering shock. And by that we mean to be the smallest drop in income such that the country will default without a standstill, but will repay if the standstill takes place. Okay, so it's what's the smallest amount that I need to push me to default, but if I give you something.
How do you know that it will repay after? Because there's a trend in the endowment shock, or
I'm lost in the question. So what we do is
in three,
the
country default without the debt relief, but repays with a standstill, but they repay in T periods.
No, repays today. Repays today. That's what we mean. Means that if you have a standstill, you wouldn't. What I mean by that is, if you had a standstill, you wouldn't declare a default.
It will happen in T periods or not.
Or not. Yes.
But do you do that at which initial value? The needs of the
at the mean debt. Was that a question?
Yeah.
Yeah, we do. All the exercises are starting at mean debt.
And can you translate 1, 2, and 3 in terms of standard deviations?
Yeah, it's coming in the next slide, but it's roughly 1 to 3.
Okay.
It's roughly 1 to. No, it's more. It's a bit larger. The standard deviation is 1.5, and I'll do it for you. Okay. All right. So those are the three sides of the shock. Now, what the standstill, related to Ali's previous question, what the standstill in the model exactly means is capturing these 4 bullet points. That is, during T periods, DS stands for debt standstill. Okay. During T periods, there's no debt payment. And there's no debt payment on the legacy debt, the one you started with, and there's no debt payment if you borrow. Because during the standstill, and that's the second bullet point, the government can still borrow or buy back debt if they want. So they can move their debt position freely. Now, the debt that enters in this standstill grows at a rate RDS, which is going to be equal to the risk-free rate plus the average quarterly spread. This assumption that the debt, you can think of it as debt in arrears. This assumption that the debt in arrears is growing is consistent precisely with the stated purpose of the standstill, that is not to punish these guys. Okay. So almost everything I want to say is for us to move in that way. Okay. Now, during the standstill, at the beginning or during any of the TDS periods, the government can declare a default. And if it does so, the standstill agreement ends because the debt goes away. Okay? So that's what the standstill is.
So the idea here is that you have a really bad shock like COVID-19, and they do this and nobody expected this and so on, and you want to see what are the effects for welfare of what the G20 did last year.
Exactly. And we're going to compare it with other debt relief strategies.
Very, so, but the spread is independent of the risk that these guys will declare default.
No, the spread is endogenous. So
when you say they're 1.85.
Yeah. This is the average spread in the economy that I calibrated.
Oh, okay.
It's the average spread. Yeah. All right, so that's what it stands in. Yeah, go ahead.
If you default, there's re-entry, recovery value is 0.
So everything up to here is recovery value 0. And I want to show you that the main functions are also robust to positive recovery. Okay, so we're going to measure then the relative merits of this strategy, of these debt relief policies, by looking at two things. So we're going to look at the welfare gains for the government, which are measured in the standard way, the permanent consumption, equivalent consumption, whatever, you know what I'm talking about. And then for the creditors, we're going to look at their capital losses. Okay, and their capital losses are defined as the percent decline in the market value of the debt at the beginning of the period. Okay? So what is that market value? The market value of the debt, say in the model that I showed you before I started talking about debt sunset, is the amount of debt times the repayment decision. So if the government defaults, the market value is 0, times 1, which is the coupon, plus 1 minus delta, the fraction that's still alive, times Q, which is the market price after today's decisions are made. And so that's the market value that we're going to be focusing on. And a capital loss is a percent decline in this guy. Now, if there is a standstill, the definition of the market value changes because things have changed, and that is given in this second line. Essentially, the only difference is that there's no coupon payment today, and I'm not multiplying by 1 minus delta, but I'm multiplying by 1 plus R, which is the rate at which the debt in arrears grows. That's the market value of the debt. So, percent declines in this guy are what I call capital losses. Okay. So the question then that's in the gray box is, what is the best debt relief strategy for a given creditor loss? That's how we're going to be disciplined in the exercise. We have nothing to say with regards to how or if capital losses can be imposed. So it's, that's we don't really have any insights there, but it's conditional on a given size for the capital loss, which debt relief strategy is better.
So is there an assumption here that at the end of these policies, everyone is going to always pay?
No, there's no assumption. The assumption is not there. We are allowing the government to default either during the standstill or after the standstill. So that is.
And the policies can affect those.
Yes, sure. The policies are going to affect the default probabilities during the standstill and also after the standstill. But so yes, I'm not assuming anything with regards to that. But clearly, the default probability during the standstill and after the standstill are going to be very important for the results.
So the idea is that you want to check the elasticity because assumption because you are going to impose this, so you're going to get less today, but then you're gonna get tomorrow something with more probability because and then you want to check which these two options are balanced. Okay, yeah. So you're gonna check those two. Okay, yes. All
right. So here's the sort of the main object, and I'm going to use this graph only once, but kind of everything that comes later is coming from this graph. Okay. So what I'm plotting here is that debt market value that I just defined. Okay. Over the initial debt level, and I remember that 44 is the mean debt level, and at 44 is where I'm evaluating the stuff. Okay. But I'm plotting all over so you can see. Okay. So this sort of golden line here is the market value curve for no shock. Or if you want, this is the market value of the debt as I increase the debt level and income is at the mean. That's this guy, the yellow one on top, right? Now, just for presentation, I'm just going to focus on the large shock here. The large shock does this thing to the market value. So it goes down, increases the market value of the debt, and it also takes the peak from here that I even plotted to the left. Okay. So it puts the economy in a position like this guy over here, and that's what we call an overhang, meaning that a reduction in the debt is mutually beneficial. Market value goes up, that's good for the creditors. Less debt is good for the country. So that's doubly was important overhang. Okay. Now, the same shock, but coupled with a 1-year standstill, that's the blue line, 2-year standstill, 3-year standstill. Okay. So what we find is that imposing or implementing the standstill lowers the market value and increases what we call the agreement zone. The agreement zone is the area from the starting point and the peak of the market value curve. And we call it the agreement zone because, as I just said, creditors and debtors can agree on reducing the debt up to that point. Okay. All right, so that's what happens with the standstill. So it lowers the thing and sort of increases the amount that you and I would be happy to reduce the debt. So, okay.
Yeah, you're avoiding the default with the standstill, right?
Look, that's a good question. With this standstill, we are not avoiding the default because the large shock without the standstill, which will be this black line, doesn't default here. If you pay attention, this line disappears, and that means that at that debt level, for the same income shock, this guy would have defaulted.
Okay.
So, as I said, I'm going to analyze 3 types of shocks: small, large, and default triggering shock. And in the default triggering shock, what you have in mind?
Oh, I thought it was that one. The default
No, but it's coming.
Yeah.
Go ahead.
I understood the middle point, like saying, here standstill from the point of view of the creditor. Standstill is going to force everybody to not get a few bucks now, but maybe you're going to get more in the future. You're saying no, that's not.
I'm saying it's possibility, but I'm saying that it's that's a goal. Something else happens.
Okay, will you tell us why?
Sorry?
Why you tell us why the trade-off is always solved in one way? It's just a feature of this particular calibration.
No, it's well, I didn't solve it for different calibrations, but I don't believe it's a feature of this calibration. I'm going to tell you that what happens essentially is that during the standstill, the debt grows, right? And therefore, that compensation that you get from your face value of the debt growing is not enough for the actual increase in the probability that happens. So in the end, you end up with more debt that is valued less because there's a much higher default probability. It's not, you guys aren't properly compensated. That's what happened.
So is it obvious that this is the agreement zone because you're taking more debt but at a cheaper price because you're paying the average interest rate 1.85, which is lower than the market price for debt. So if you not
Given that this
take the arrears,
yeah,
you're paying a lower interest rate than what you will get if you issue new debt. So you're increasing your debt at a cheaper price.
that the legacy debt.
Right.
You can also issue new debt, which will be at the market price.
Right, but it's obvious that you want to buy back debt, or like you would like to go to the left.
Well, I think so, right? Because if you go to the left, these guys get a higher market value, and having less debt is always good for the government. If you want, trivially, not trivially, but bluntly, the value function is decreasing in debt. I'm not sure I get your point, but
Yeah,
No, I think
so César, a key ingredient here is that when you do a standstill, and the debt is growing because of the interest rate that was charged before the standstill. The deal doesn't take into account that when the debt grows, the default set of Y gets bigger and the probability higher.
Yeah.
And that's what creates a loss for the
correct.
creditor.
Yes,
Okay.
they are improperly compensated. No, or not sufficiently compensated.
Yeah, but yeah, that's the reason is that one. Yeah.
The reason is that one. Correct. Okay, so this is what happens to the market value of the debt. So as I said, I'm going to measure the capital loss as the proportional decline. So the proportional decline will be, this is how much it falls due to the shock. Okay, so that's line, that you're going to walk away from. And now the proportional decline is from here to here in relative terms. That's the capital loss of the standstill of 1 year. Or from here to here, 2 years, 3 years, right? Okay, so that's what I'm plotting now in this space, that I have the capital losses on the horizontal and the welfare gains on the vertical. So as I argued, doing this thing is beneficial for the creditor, sorry, for the debtor. That's what I'm measuring on the vertical axis, the welfare gains.
what happens if you have only short term? Is this because of the dilution?
Yes. So this is because of there's long.
No, there are many things.
There are many things.
I'll go back to one question, because if this is always the case, because there are there is tension between two effects, and you're saying that one is winning here.
Yes.
And then there are many features, and then do you know which is the feature here? Is the debt dilution is because of long-term debt, or is I don't know.
So these guys, the fact that this is curved is because
It's always going down.
yeah. It's always going down. So
it's all one effect is winning to the winning
Yeah.
here. The increase in probability to pay is not as high as you're losing some money because you're not getting money today. So is that coming because of the debt dilution? Because if you get that deal, increase the amount of debt, and then you are gonna that dilution is coming.
yeah, it's because of that dilution. Generally, I'll make a point that in the end it's not that important, because what the government does during the standstill, it doesn't. If it were really truly the dilution, you would work. The worry is that the government during the standstill will issue a lot. And what we find is that it doesn't really. And it doesn't because it knows that the debt is growing. So it is, in a sense, it is about the dilution, meaning it is about the growth in the debt that's coming, and therefore the higher default probabilities in the future. In that sense, it is about the dilution. It is not about the dilution in the sense that there is not a lot of issuance during the standstill. I made myself clear.
Yeah.
So there is a bunch of combination of things, a bunch of debt that's rolled over automatically, and on top of that you can issue. That issuance isn't a lot, precisely because
It's only when the contrafactual where you put the short-term debt, it's like delta equals 1 or 0. So you get these pictures?
no, because with short-term debt, this thing is not bending. It doesn't bend. It's either positive, right?
Yes.
Or it disappears. Sorry, it's either upward sloping or it disappears.
Yes.
So there's no possibility to be on the wrong side of the Laffer curve.
Yes, but then if you have an extension of the period to pay,
Yeah.
you go down.
It will go down.
So
Also
it's still,
vertical.
the effect is still
I
there.
think it's still there. Yeah. Okay. So as I said, these proportional changes or its proportional declines is what I'm going to call a capital loss.
You have half an hour.
Thanks. So I'm plotting here these two elements that I'm going to use, or these two metrics that I'm going to use to say whether the debt relief proposal makes sense or not. The capital losses that I just explained and the welfare gains that I said are computed usually. So 0 here, 0, 0 is the do nothing policy. The shock hits you, tough luck. Okay, and every other point that I want to plot is compared to that 0, 0. Right, so a 1 year standstill gives you maybe 0.3 welfare gain and something like 20% capital losses. And something, you know, proportionally here like 0.5 and 30% capital losses for a 2 year standstill. Okay, and this looks very odd. As you can see, as you can imagine, then I'm going to fill the graph. All right. So what happens during this standstill? What happens after the shock and the debt regime? Okay. I'm going to illustrate that by looking at some impulse response functions. This is the shock. Okay. So this is the large shock, the shock that increases spreads by 1,000 basis points. And I'm going to show sort of transition paths for a 1 year standstill. Okay. So what we see is that the spreads, the black line is the do nothing policy, and the dotted red line is the 1 year standstill policy. Okay. As you can see, the standstill increases the spread that the government pays because all the lenders know that this is happening. That the debt during the standstill is increasing. Okay. And that translates into higher default probability, which I had a plot for, but I didn't show. So you see that the bond prices drop, and they drop much more than in the nothing policy. Okay? And the capital losses are precisely what I was talking about, these reductions in the market value. And all of this happens, even though, and sort of a reflection of this is that during the standstill, there's not a lot of debt issuance. This is debt issuance as a fraction of annual GDP. So there's debt issuance in the beginning of the standstill at period 0 and period 1, but then there's even negative issuance because the government knows that that all the legacy debt is increasing, so they don't want to.
What's a period there? It's
a quarter. So they don't want to overexpose to themselves to default risk. So remember
understand the spread because that the spread is falling.
Yes.
But they thought that
after the shock.
time,
After the shock.
no, but you have the difference between the difference between the standstill and the other one is narrowing. That condition does not default or something.
Yeah.
Because you said that as time goes by, the debt grows.
The debt grows in the
and that increases the default.
Yes, but the income also recovers. Are you perplexed by the downward sloping? It's
no, by
less
the narrowing
between
the standstill and
the debt positions are becoming similar. Right.
I see.
Yeah. Okay, so this is the graph that I had before, right? And what the point we want to make now is the one on the title. What we want to compare is this debt relief policy, the standstill, with haircuts. Okay? And what we find is that exactly what the title says, that haircuts still deliver welfare gains for the borrower and minimize creditor losses. Okay, so what I'm going to do is I'm going to start on what we thought at the moment was a policy relevant point, the proposal of a 1 year standstill. I want to do different sizes of haircuts around this guy. Okay, so each dot in this new blue line is roughly 7% haircuts. So what we show here is that for this large shock, something like a 20 or 21% haircut can increase the welfare gains for the sovereign to roughly 0.8 and minimize the capital losses to something like almost 0. Okay? So what we find is that if for X reason, political or otherwise, we agree on a standstill proposal, it is a good idea to couple that with the haircut.
That's the optimal haircut. That's a any haircut. No. That one.
Okay.
How much of the debt is that? How large is the haircut?
The haircut, as I said, so each dot is like 7% cumulative.
Oh, sorry.
7,
You said that. Okay.
14, 20. Yeah.
Oh,
It's large. Yeah. All right. So now what we're going to do is, what happens if we do the haircut? I'm going to go back to the same path. If we do the haircut, we see that, well, the effect of the haircut is precisely this. The head goes down.
Yeah.
Right? And when that goes down, then the default probability, which again is already employed, that also goes down, and that immediately gets reflected in the spread. So there's much better consumption smoothing, and the market value of the debt, essentially, as I showed, is essentially unaltered at the beginning. That is the zero capital loss. All right, so here's where I was saying, this is what happens if we do standstills. This would happen if I couple a standstill with a 1 year standstill with a haircut, and now I can completely populate the plot by looking at different standstills at different values of the haircut. Okay, and what we get? Yeah, go ahead.
The market value is the price of 1 unit, no? Or
Yes.
the price of the total. So you still lose 20% of your capital.
No, because there's an effect on the prices.
Okay.
Now I'm going to fill the plot, and what I'm going to show is again what the title says, that only using haircuts is the best option. So if you do a zero standstill and put something like maybe like a 10 or 14% haircut, that gives you actual capital gains or negative capital losses and welfare gains. Or if you want to think it this way, by keeping capital losses at zero and imposing a haircut of roughly 30%, you can increase welfare by a bit more than 1%. Okay, so what we find is that the losses from just relying on standstill can be substantial, but the losses from a standstill are negligible if we can agree on a large enough haircut. That's when these lines sort of start getting together. Okay, so if the haircut is sufficiently large, then imposing a haircut for whatever political reason you want to do isn't that common. Okay. Now all of that derivation and the pass and where for the large shock, the one that I said is measured as how much the income has to fall for spreads to go up by 1,000 basis points. All of these holds for the other two shocks. Okay. So on the left, this pump already left, but this was like a 5% decline, and this is like a 3% decline. Okay. On the left, you have for the small shock, then you qualitatively this is the same. The one thing that's maybe a bit more interesting to talk about is about the trigger default shock. That is the drop in income that will make the default if I don't give you the standstill. Okay, that's on the far right, right? And what we see is that for all the combinations of standstill, in the 1 year, 2 years, or 3 years, you get negative capital loss, meaning capital gains. And that's kind of obvious because absent the standstill, you get zero, because it's like default. And with the standstill, you get something. Okay? So it's not a paper to argue that standstills are a bad idea. Probably what the G20 had in mind is this situation. If we don't do nothing, these guys are by default. Right? The point that we want to make is that if you're going to do this, it's a good idea to do this together with haircuts. Because even in the trigger default situation, if you couple that with haircuts, then we are showing here, and then you can have Pareto improvements, meaning both guys are better off. Okay. So that robust result that coupling haircuts with standstill is Pareto improving. That is a robust result. That's what I want to say.
So do you know how many countries, you might answer this later, use the options of doing the standstills?
Yeah, not that many.
Not that many, right?
Not that many, because there are...
Because
it's in
there is some cost of default.
Yeah, in a sense, it's captured here a little bit, but I don't think fully. The discussions that we've been able to sort of uncover for why countries are not doing this, they are afraid of some stigma. So they don't want to be seen as imposing losses on the creditors. So actually, not that many countries took it. This is still nonetheless pushed by the World Bank and so on.
For the very few countries I know this, it's like the Chinese, they want to participate, so it made the other ones hesitant.
Mm-hmm.
And the private debt they had was so small, it was not worth it to standstill and pay the reputation cost with the small private debt.
No.
And with the official ones, they were this fight between the price club and the Chinese, so at the end nobody used it here. But
Few countries used it, but how yeah. Yes.
oh, because but that's telling you that the proposal might be even worse because standstill that in the model is free entails some cost. Well,
Correct. I'm not. I'll take your comment as we are not modeling the cost for the country of participating in the standstill.
Yeah, because I don't.
Every country in this model will take it. We see
Yeah.
the data that it's not the case.
Yeah, we don't know if it's because the countries didn't want to take it or because at the end of the day, the official creators didn't agree on how to do it.
Maybe there's some implementation disagreement how to do it,
Yeah.
the rate at which the arrays will grow or whatever. In any case, the point of the paper is that
That's our idea.
that's that idea anyways. But, even though I just said I don't want to sell the paper like that. I want to say that coupling with haircuts is a better idea.
Could you
All right.
improve the design of the standstill? For example, you increase the rollover rate.
Increase the rollover rate, that doesn't change the results. There is a point in which decreasing the rollover rate is like imposing a haircut. Right? Making it, imagine the rollover rate is now negative instead of positive. That is like a haircut.
Right, but the timing of the payments are different.
Time is of payment is different. Yes.
I thought that that part of the fall of the market value was because the rollover rate was different than the market interest rate.
That's gonna still be, that's probably gonna be there. Well, I mean, we know that it's there for other rollover rates. Now, the higher goes the rollover rate, smaller is this drop.
Right.
So
So probably you're going to increase the rollover rate, but the haircut too, a better combination of those two.
yes, yeah.
I mean,
So we didn't search over, say, the ex-ante optimal version of this. Say that I can choose the rollover rate and the haircut. Yeah, we didn't do that exercise. All right, I kind of gave this out already, but what we think that the intuition is pretty simple. After a negative shock, like the one we're thinking of, the price of
when you compute the haircut, you're going back to Gastón question. You're computing Q times B. What's the value for the creditor? Q times B, right?
no, it's what I defined before, but essentially Q times B is the most important part. Let me go jump back.
You because the price is gonna move.
It's B times
Okay.
default times the coupon. So in a repayment state, the coupon is small. And then 1 minus delta of the bond is still alive. And
But
it's B times Q is there.
Yeah. It is there.
Yeah.
Okay.
And what happens to Q is very important. That's what I've been trying to say, and I'm going to say now.
Wow. It's relative, right? Because
Relative, yeah.
Q
because-
is gonna move in some direction, but B is going down, so you have to compute that.
Of course,
Okay.
it's about that. What happens
Okay.
to us? So, all right. So here's where I was. So the intuition, I think we want to think that this is relatively simple. After a negative shock like the one we're studying, the price of debt becomes particularly sensitive to changes in the debt level. In these models, always is, but with a negative shock of this magnitude, it's even more, right? And essentially, a standstill and a haircut move the debt in opposite directions. Right? Haircut reduces the debt and increases prices, right? And the standstill does the opposite, increases the debt because it grows, and the price drops low. Okay? So it's this tension between what happens to the amount of debt and the price that makes the standstill a bad idea compared to the haircut. And so that's the intuition for the result. All right, so I think I said almost everything. Let me tell you that our results are, as I said, robust to different changes. One is to modeling the shock differently, right? Instead of this drop and recovery following the year one, imagine that we can have a more temporary drop that is maybe capturing better slow recovery that we saw or we thought we were going to see after COVID-19. Okay?
The COVID recovery was very fast.
Exactly, that's what I said. We thought we were going to see. we wrote this version. You'll see what I mean. More like a U-shaped recovery. It's also robust to adding standstill, and this is actually quite relevant. And it's robust to adding a positive recovery rate or modeling the shock as a dead shock, and so on. It's also robust to different rates at which the dead in area grows. Okay, so this is the different nature of shock. This is what I mean. So imagine that that the level of income gets downgraded by 1 minus chi, right, during 4 periods, and then it recovers by a quarter during the next 4 quarters. So essentially, it takes 2 years to go back. Okay, what if this is the more U-shaped is the behavior of the crisis? Okay, so what we'll find is that essentially the results are the same. Maybe these plots are indistinguishable, but these are for these different income shocks. We find that a large shock of that nature, coupled with a haircut of roughly 20%, gives you welfare gains and capital gains. So this is like okay, so the results do not depend on that particular nature of the shock. This is more interesting. The motivation for doing this extension is that one of the main concerns was that there's a liquidity concern during the crisis, and the idea is that particularly in those periods, the standstill may be helpful, right? Because maybe it's not a solvency case, but it's a liquidity, right? So we want to capture that by assuming that the country cannot issue new debt for during a year, right? The market freezes for that, right? It can buy back if it wants, but it cannot issue new debt, right? That's equivalent to imposing like these constraints on top of the previous one, right? But it's essentially you cannot buy, you cannot issue new debt, right? And we want to define the shocks in the same way. What we find there is that when you add a sudden stop, we still get a robust punchline, meaning that not including the haircuts in the design of this debt relief is not a good idea. It's not a good policy to just rely on the stance. The result that only haircuts is the best policy, that is not robust to this, because you see these lines cross here. Okay. So the basic idea is that if you're going to impose a standstill, you better do it with haircuts, which is moving from here that direction. That is robust, and we want that to be, in a sense, the point of the paper. We have like 10 minutes. Let me say that again, these main results hold if we allow for positive recovery, and that's how this is how you will need to change the model to allow for positive recovery. Now the recovery is going to be fraction alpha of the debt, or the level recovery is going to be alpha, the minimum between alpha and the debt. So if you default for very little, then you recover everything. If you default for a lot, then you recover only up to alpha. So prices are going to change, but sort of in the usual way. Now the figures look a bit different, but conceptually they look kind of the same. The main result is that standstills alone aren't a good idea. If you're going to impose a standstill, you better couple this with okay. Since similar times are inequality constraints, I'm gonna be non-binding here, and I'm gonna say that what we find, or what by evaluating this policy quantitatively, is that doing it without haircuts doesn't seem to be the best strategy. Imposing this debt standstill create this idea of debt overhang being on the wrong side of the Laffer curve, and therefore they are themselves creating a role for haircuts. If for whatever reason standstills without haircuts are favored because of regulatory cost of haircuts, which is something that Juan and Max and other people have working on, or because of doctrine of necessity, or whatever other reason you may want to push for avoiding haircuts, then we find that the inefficiencies of those regulations, the inefficiencies of those sort of market designs appear to be significant. And that's it.
Okay. So,
Let's go for the time shock. We have 10 more minutes.
now we go to the roof of the other building for lunch.
Dejamos la cosa. Está muy bien montado.
Cerramos con llave acá. Te devuelvo. Entonces es la terraza del otro.
Sí, lo tengo. No, pero sí que lata.
Eso sí, pero es de simples, estás comparando.
¿Vas a cerrar?
Sí, 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 todo tranquilo.
Mira, para el gobierno, para el gobierno, es por esta línea roja. Y la ilocanesa es
No, pero lo que quiero decir hasta qué punto
el punto del
viste, porque los otros saben que este tipo le conviene el standstill.
podría poder chequear eso.
Porque si vos sabés que los que son más impacientes, vos sabés que van a siempre. Entonces vas a cobrar, a evaluar el
workers, for example, who work for US in Argentina, they pay taxes in Argentina or in US?
For the whole world.
They should pay taxes in Argentina. They should. So the taxation is like very country specific. Like if you're a US worker in the platform and you're hired as an employee, then you're going to get a W-2. The platform has systems in which facilitate that. And in some other big countries such as India, the platform will, countries big in terms of number of workers, the platform will help you with the taxes. For an Argentinian worker, I couldn't find anything. So I guess it's up to you to kind of be like a monotributista or something like that. Okay, so
You can't lie and say that you are in the US while you are in Argentina, for example.
It's
Other way.
that's hard to evaluate for us. I know that the website does not let you create an account from another country that kind of reads that, right? I guess you could travel to the US, open an account, set up a bank, and I don't think that the platform can track you around the world. Okay, so let me give you a bit something about the data. Then I'm going to show you the platform. So what is a web-based platform? If you didn't know, the key thing is that they're going to match workers and employers, and these are jobs that are performed and delivered remotely, right? So we all, like at least in the US, we're kind of used to using job platforms to find employees. For example, I want to find a nanny. I would go into a platform called care.com. They'll give me a list of local nannies in the area. They will contact me with them, right? So here, pretty much the same, but the difference is that these jobs they do not require an in-person presence, so the platform is just going to match me with anyone. So it's going to match me with people from anywhere in the US or in the world. These are kind of becoming more fashionable. The number of platforms of this kind of platform has tripled in the past decade, and in 2020 accounted for $50 billion in revenues. Now, the one we're going to scrape is the largest one online. About 3 million jobs worth over $1 billion are posted annually in this platform. The key thing for us is that this specializes on remote jobs, and they encompass a very wide range of occupations, from accounting to web development. So these are not all data entry. I mean, these are different kinds of jobs. And although the platform claims millions of registered users, we're going to focus on some sample of workers, 100,000 that are actually active in the platform, meaning they have reported earnings over the past year and like that. Okay, so this, you go to the platform, and this when we scrape it, this is how it looks like. Right, so you go, you have a bunch of profiles for individual workers. You click on a profile, you get something like this. And this being anonymized, so here you have a picture and a name, right? But then we throw that away. I mean, we're going to keep a worker ID, but what we're going to use mainly is the location of the worker. So this guy from New York, and then we're going to scrape. The worker gives you kind of like a brief expert of what he can do, right? So this guy is a designer. The worker is also going to list the sector, so you're going to find this working in a particular sector of occupation. Right? So web design would be like an occupation. And then we're going to see an hourly rate, earnings for the workers that are cumulative, the number of jobs he performed, the number of hours he has worked total, and then we're going to have some quality measures, like this guy has completed 100% of the jobs he's worked with, and is certified by the platform to be like a top-rated worker, right? To be a top-rated worker, you have to have a job success rate of 100% and have earned $1,000 over the previous year. And yeah. Okay, so we're going to scrape all of this. Then you scroll down, the platform is going to give you some skills for the worker. So the worker is going to, from a predetermined list of skills, he's going to select the ones he can do. So again, this is a designer, so he has a bunch of designing skills. And we're not going to do much with those. But the last thing we're going to pick up is the worker can take tests online on the platform. And everyone on the platform from anywhere in the world is going to take the same test. Okay? So these are standardized tests that the platform provides in which you can certify some skills. So for example, this guy has completed a photography certification test. You have a score, some percentile of how you run the distribution. So we're going to scrape this as well. So this is going to be one more measure of the workers' equality. Okay, then the next thing we're going to scrape is you can click, I mean, you can download the job history of the worker in the platform. right? So you can find all the workers all the jobs that the worker has completed. And here we're gonna pick up the hourly rate, the total amount that the job was transacted for, the hourly rate, and how many hours has it worked. So we have both like this kind of ask wage that the worker posting his profile, but also we have how much he has, how much he got paid for each one of these jobs. And also we know the start date, and that's not shown in this slide because it's just kind of hidden in the website, but you can also scrape the client, the country, and the ID of the client for each of these jobs. So for each job, we know who hired you, where he lives, how much do you make, and if it was an hourly job, we know the hourly wage, and if it was, some jobs are just like a fixed price job, so for those we don't have an hourly wage. All right, so some basic statistics. The workers are spread across 183 countries. So some of the graphs I'm going to show you today are based on a smaller sample of countries that have like at least 100 workers, but this is not very important for the results. There's a lot of variance in the hourly wage in the platform. So the average wage is $25 per hour. The median is just 18. We're going to show you more about that. There's also a lot of variance in the earnings. So you're asking me if this is part-time, full-time. So the average earnings in our sample are like 19K. So maybe that's a full-time job for somebody in a poor country. The median is closer to 4K, which is okay. So let me first show you what are these workers doing. So here, so you go into the platform, they have some broad pre-selected job categories. So there's 12 of these. So these workers are in web and software, design. So this would be like design my website, design a logo for my company, stuff like that. There's a lot of sales jobs, writing, admin jobs, and then less important jobs are customer service, data sciences, engineering, translation, accounting, and even some legal jobs. So the point here is that the jobs are not just programming jobs, they're kind of spread across the web. Then within each of these categories, you have more like subcategories, which we're going to use later in the paper. So for example, within the web and software jobs, there's a lot of categories like e-commerce developers and web developers, so desktop software developers and so on. So within the developers, you have like different kinds of developers. Perhaps more interesting, where are the employers and the workers located? So the workers you can see are mostly in developing countries. Like India is the country with the most workers. The big exception, of course, is the US, that has a lot of workers. And then Philippines, Pakistan, Ukraine, those are the most important countries. And then other non-OECD countries account for around 25%, right? So the workers are kind of spread around the world, mainly concentrated in developing countries, with the exception of the US. The employers, on the other hand, are almost all in OECD countries, and especially most are in the US. So US accounts for over half, and then we have workers in Australia, UK, Canada, and other OECD. So non-OECD employers in non-OECD countries are not that many. So from this slide already, you should see, or you should guess that there's going to be a lot of cross-border trading. Okay, so now let me start showing you some results. So the first thing we want to look at is how these workers' wages change across locations.
Javier, and this worker slide is the same also for the intensive margin. This is the extensive margin.
Yeah, this is the number of workers. It looks relatively similar. I mean, it's going to change if you do it for hours or earnings, but it's kind of the same idea. Okay, so the first thing we're going to look at is how these workers' wages change depending on where the workers are located. So we're going to run a regression of this form. We're going to have the low hourly wage of a worker I, right? And we're going to regress that with a bunch of worker-specific controls, which are the variables that I showed you in the first slide. So we're gonna put, we will have these specifications that we can throw in the skills, experience, the quality ratings, and the availability of the workers. And we're gonna have dummies for the worker sector or occupation. So if you're a developer, there's a dummy for developer and so on. And then here we see, this is gonna be what we're interested in. These are the country dummies. So these are dummies that take a value of 1 if the, I mean, for the country of the worker, right? So, I mean, we could have just taken average wages across countries, but we're going to do this after residualizing for all these observables. So the dummies are going to capture the residualized average wage in each location. Okay?
So when you do the ratios, there WI over WJ with the condition on X for different countries, you get something that looks like the wage ratio or relative per capita income.
That's coming in 2 slides. So first, there's one slide just to show you that these controls kind of look the way that you would expect. More experienced workers earn more, workers with more skills earn more, workers that are top rated, that there's a premium for being top rated. And something that comes out of this relation that the workers' country, I mean, the country dummies account for over 1/3 of the variance in workers' wages in our sample, which is a lot considering that this is microdata. And all these other controls that we have, including the sector of the workers, account for another 1/5 of the variance. Right, so already most of the variance, I mean, most of the explained variance in wages is coming from the workers for the country of the workers. Okay. Now this is the results, or this is our first set of results. This is what Andy was asking about. So this plots the residual wage difference across countries. So on the x-axis here, I have the GDP per capita of each country relative to the US. And on the y-axis, I have the dummies that I estimated before, right, exponentiated. So these are ratios. The dummy was in log. So the first thing you should see here, and everything is normalized to the US, right? So one is, so US is here, 1-1. Sorry, the US is here. The US is 1-1, and then each country is going to tell you what is the income per capita of each country relative to the US, and what is the average wage that the freelancers from that country are relative to the freelancers that are located in the US. So the first thing you should see here is that, of course, there's a very strong correlation between the income per capita of a country and the average wage that the freelancers from that country are making. We have all those controls. I mean, this actually looks quite similar. The graph is less tight, but it looks quite similar if we don't have if we just take like simple means. But if you're thinking that, oh, that's because the freelancers from Italy are somehow better than the freelancers in India, well, that's at least not captured in our observables. Also taking into account that there's some quality ratings like here, right? So this is not just the skills. This has like those like star ratings for the freelancers. We can also run a version of these that controls for the employer's location, and you get very similar results. Right?
And language? And with language? Because it seems like small for the 0.2.
See, so with language, no, we don't think this is by language for 2 reasons. Number one, there's a English language test. So among the tests, we do have some certification whether the worker passed this English test, right? You can tell me well, it's not.
Yeah, that's. I was surprised that the 0.2 is small.
And 0.2.
The slope, that slope is small. Okay, we go to a poorer country, the wage falls by 1/5 of the per capita income. So these guys are really well off when they sell abroad. So maybe the fact that they speak different language makes them different relative to local population.
Yeah, okay. So let's talk in a second about whether it's surprising and how to interpret the results. So for now, I just want to document this is how the average wages look like. And if you think, oh, is this language? Well, know that this pattern is not US versus the rest, right? Like even across non-English native speaking countries, you have Spain, it's about Argentina, which should be somewhere here, it's about India, right? And we do have controls for English speaking. Okay, so the two messages I want you to take away from this is, well, despite everyone working remotely on this platform, and despite the fact that everyone is, I mean, you can be hired by employers from the same location, we continue, these differences in wages across countries are pervasive. And they do not seem to be mechanically accounted for by these observable differences in workers.
So the two players are what? Philippines and?
This is Philippines and this is Bangladesh. Okay. The other thing to note is that what the elasticity, these are the difference in average wages are much smaller than the difference in GDP per capita. Okay. And that could be also for a bunch of reasons that we can discuss. Okay. Okay. So that's the first finding: the wage difference across countries. The second one is about wage difference across US states. So now we kind of redid the same thing, but instead of having we did just for the workers that are located in the US, and instead of having the country of the worker, we are now going to have the state of the worker. We're going to do everything across California. So here, Andy, everyone speaks English, or they should. And we get a surprisingly similar slope. Okay. So that's kind of the first fact we want to convey. Everyone's working remotely in this platform. There's still pervasive differences in average wages across the remote workers that are located in different places. And so what I want to do next is I want to do two things. I want to talk about how these wages change when we have shocks to the exchange rates. But before doing that, what I want to do is I want to lay down a simple model. Let me skip this. Of wage determination to see if we can interpret the results we've seen so far, and also to motivate the empirical analysis that's going to follow. Okay. So this is kind of the simple model. I mean, you can write a lot of models that can account for this kind of relation. This is kind of the simplest one we wrote, and hopefully it's strong enough to capture your favorite stuff. So consider the following model. We have a competitive labor market. There's a final good that is produced by aggregating the output from different sectors. So here J denotes sectors. And then output from each sector is produced by combining the remote workers from different locations. Right? So this is the output from in sector J. It combines workers from different locations, and we're indexing the locations by C. And then LJCT denotes the efficiency indicator of labor that are coming from location C and are used in sector J. And then this omega is the wage per efficiency unit of labor in sector J for workers from location C. Right? And then, so cost minimization is going to imply that the labor demand for workers for efficiency units of labor from location C is the usual CS form. So here, P is going to be the cost function for producing a unit of output in location C. Sorry, P is going to be the unit cost for producing a unit of output in sector J. And A, right, is going to be a demand shifter, right? Here we're putting it on the production function. But this is just some demand shifter that's going to increase or decrease labor demand from location. And we're going to close the model by having an upward sloping labor supply, which is very easy to microfound. But here, let me just assume that the labor supply depends on the wage that the worker can make in the platform. That's the omega J relative to the wage in the local labor market. So theta will be supply elasticity, and then this NJCT will collect different types of supply shifts. Right? So again, we have a specific example of a model that delivers this, but it's not kind of hard to obtain. So that's it. That's the model, and potentially has two key ingredients: downward sloping labor demand for workers from a particular location, and then upward sloping labor supply for workers from the same location. Right. So you put the two together, and you find the equilibrium wage per efficiency unit of labor for workers from location C. Right. So here we have demand equals supply, and then we can solve for the wage per efficiency unit for a worker from location C. That's not what we see in the data. We see a wage per unit of time. Right? So that's going to be just the wage per efficiency unit for a worker from location C multiplied by the number of efficiency units that the worker is bringing. So in logs, we can obtain an equation like this. This is the log wage of worker I. That's going to depend on the local market wage that the worker can earn. And then it's going to depend on the cost function for producing in the sector. Right? So this is going to capture all the other workers' wages. And then this is going to collect all the supply and demand shifters that we don't observe. And this is an average shifter. After changing demand in the platform. And of course, we're going to be scaled with the productivity or the efficiency units of this particular work. Okay. So the question is kind of intuitive. It tells you, well, if workers from different locations are perfect substitutes, then the only way you can have difference in wages is if these guys have different productivities, right? So you would only pay more for somebody that's more productive than somebody else if everyone's a perfect substitute. On the other hand, if the supply of labor was perfectly elastic, then the wage is going to be given by the local market wage if you're working on the platform. But in general, right, these elasticities are going to be between 0 and 1. And it's going to depend on how elastic is the supply of labor relative to the demand of labor. So one way to interpret what the results we saw is, well, if you think that local wages across countries are kind of moving with, or the difference in local wages across countries is kind of proportional to the difference in GDP per capita across countries, then one like very naive way of looking at the graph we have below is to think, oh, well, then that slope that we saw 0.2 corresponds a bit to this ratio of elasticities. So that's one way of having an upward sloping demand that is less than, an upward sloping relation between wages and GDP per capita is between 0 and 1. Of course, there's some issues with that. Number one is that the workers' productivity may be related to income per capita, right? Even though we try to control for this. And the other is that we have all these shifter here that are not controlled when we look at the cross section. Okay, so that's one interpretation, Andy, for why they will make.
So what are rho and theta? Theta and rho or what?
Theta, what do you say?
Theta and rho.
No. The ratio is 0.2. No, not even. I can't convince you that. I just say, and if you think that slope was covering this partial elasticity, then the ratio is 0.2. Okay. So now we're going to use time variation to try to say more about it. Okay. Okay. So implication for wage changes. So we're going to make one more assumption. We're going to approximate the change in the local currency wage. Sorry, the change in local wages expressed in dollars. We're going to approximate that with the. So that's the log change in the dollar wage that a worker can make in location C. That's just going to be the sum of the real growth in that occupation in that location, which we're going to call gamma, the inflation rate in that country, and the change in the nominal exchange in that country expressed in dollars per local currency units. And so local wages expressed in dollars can grow if the currency of the country appreciates, if there's inflation in the country, or if it's some real growth. And then we substitute in the equation for wages we had before, and it's going to give you something like this. So now we can write the change in wages into some observable variables and some things we don't observe. So we're going to say that the change in the wage for worker I is going to depend on the change in the exchange rate and the inflation of the in the country of the worker. It's going to depend on this DWJ, which is the wage index, right, which just captures the change in the average wage in the platform. That's because the cost function was shifting the demand for labor before, right? And then the cost function is in part determined by the change in every wage in the platform. And then we're going to have all these shifters that we not serve. So we're going to have some sector, country specific shifters. For example, this, we don't serve the real growth in each occupation, in each country. We're going to have some sector specific shifters, and we're going to have some area shifters. Yes?
I was wondering, can you see, or do you have a variable to measure one of these shifters? Because of the previous equation, the previous slide, you could recover data, right? If you take the ratio of the two variables. If you go to the previous one.
Mm-hmm.
Here, what is phi?
Phi is a collection of the supply and demand shifters, which as of these slides are A and N.
All right, so if you, okay. But I was wondering if you could recover data from the first two coefficients. If you take the ratio of estimation and you can have some external variation for the elasticity of supply.
So far I haven't told you how we will take this to data. I mean, one way to take the data is to use the cross-section of country. And now we justify this law, but of course, if the supply shifters are correlated, we don't see the supply shifter.
Right. That's not
they're correlated, we cannot identify that. That was the question. Okay, so then this says that the change in somebody's wage is going to depend on the change in the exchange rate in the country of the worker, the inflation in the country of the worker, and then the change in this wage index, which is an index of wages in the platform. And then we're going to have all these shifters, and then it's going to change with the workers' ability. So now we're going to take this to data because we're interested in knowing how your wage is going to change when you have a shock in your exchange rate. And also we're interested in knowing how your wage is going to change if somebody else is in the wage change in the platform. When you say everyone in India wage changes, then what's going to happen to you? Okay, so the question says the exchange of path elasticity, or at least the partial exchange of path elasticity, is theta over rho plus theta, and then the elasticity of your wage relative to your competitor's wage given by rho minus theta, rho plus theta. Okay, so this is a empirical challenge we face. We don't typically see the worker in every month, right? So you saw how the data came when we scrape it. So the platform kind of gives you a sample of the jobs that the worker has had, right? So some workers we may see multiple times in a month, then we don't see her for a month, then we see her again in 2 months. Some workers we see them monthly, and some we don't, and so on. So what we do is we're going to run what we call a medium exchange rate pass-through regression, which we're going to take a worker that is observed in period T and then in period T minus S. And so if S is 2, then, so first we're going to aggregate data at the monthly level, then we're going to do this. So if S is 2, this means we're going to take a worker that we observe today, and then the previous wage quote was from 2 months prior. And then we're going to estimate this equation, which we're going to have the change in wages, the cumulative change in that S months time spent. And we're going to regress that to the cumulative change in the exchange rate between that period and the inflation in the country in that period. And then here we have all these shifters, right? So first we're going to do to estimate the pass-through elasticities, we're going to put time spelled sector fixed effects, right, which are going to count for this and for that, but also for this. And of course, we cannot put country times per fixed effects because we want to estimate the response to the exchange rate. So we're going to control for country sector trends. Okay. So the fixed effects control for the shifters and for the change in the competitor's wages. So first we're going to run this simple exchange of pass-through regression, and then the coefficients beta 1, beta 2. Our theory says that they should be the same. We're not going to impose that. We're going to kind of test it in the data. Those are going to be identified from the time and the country variation. So that's the first set of results. So here we have how the change in your wage responds to the exchange. So what this says is that your wage in dollars responds to with an elasticity of 0.14 to a change in your country's exchange rate. Right? So if you're an Indian worker and the rupee appreciates 10%, then your wage in dollars goes up by only 0.14%. And then we cannot reject that these two are different, in part because it's not very precisely estimated. If we impose a restriction that these two should be the same, then we get a very similar estimate, 1.4. So this is kind of the second empirical finding that we recommend, which is that these remote wages don't respond much. When expressed in dollars, they don't respond much to the dollar exchange rate. And then, of course, if you express this in local currency, what I just said implies that your wage in rupees is going to go down by like 8.6%, right? If the rupee appreciates 10% and you only increase your wage in dollars by 1.4%, then your wage in rupees is going down. Okay. But now we're going to try to do something a bit more challenging, which is try to see how your wage responds when there's a shock that changes the wages that your competitors are setting in the platform. Right? And in part because in this setting you can have competitors from every other country in the world. That's going to tell you a bit how changing the wages of your foreign competitors affect your wage. So this is the structural equation from that little model that we had before. Now we're going to change the regression. We're going to drop. Before this was like time sector fixed effects. If I put that, I cannot also include these wage indices in the regression. So we're going to take the sector. We're not going to interact this time fixed effect with sector. We're still going to have country sector time trends. And now there's a challenge, right? Because the change in your competitors' wages, even a model implies that it's going to be a function of all the changes in exchange rates in the world and all the changes in inflation in rates in the world. And also these phi's, which are just different combinations of the same supply and demand shifters that were entering these fees. So for example, if there's a global shock that increases demand for developers, that's going to affect you directly through these by J's. But that can also affect you through the wage of your competitors. So there's a clearly, this is going to be correlated with the error term. So what we're going to do is we're going to use an instrument that comes out of this theory, which is we can instrument the wage of your competitors by constructing this index of changes in exchange rates and inflation. So these indexes are, so these are instruments. It's a weighted average of the change in exchange rate and the weighted average of the change in inflation for the workers in sector J. And this is going to vary across sectors because different countries have different loadings on the different sectors. For example, if you are a programmer, you're going to be more exposed to competition to India because the platform, it happens to be that most programmers are from India. And then you're going to be but if you are, say, a writer, you're going to be more exposed to competition from the US because most writers in the platform are from the US. And then we're going to exploit that change in your competitors' the variation in wage is going to be sectorial. So some workers are exposed to writers, some workers are exposed to programmers, and the instrument varies across sectors because there's these different loadings. Okay, and this is the result from that, right? So this is the OLS, which says there's a positive correlation between how your competitors' wages are changing and how your own wage is changing. And this is a two-stage estimator, which first projects the change in the sector's wages or the change in the inflation and exchanges in the countries of the workers that are active in this sector. And then this just says that the elasticity is very large. So in a sense, when average works, when there's a change in inflation or a change in exchanges that increases the competitor's wage by 10%, then your wage goes up by 10% relative to another wage. That's kind of the second finding. Okay, so that was fast. So in the paper we have a bunch of different set of robustness exercises. So we try different fixed effects, and we already data different frequencies. We look at different the condition of wage changes, right? So this fact that the dollar wages are not changing much with the dollar exchange rate is not because all these wages are completely sticky in dollars, because the wages are moving, they're just not responding much to the exchange rate. Yeah, and then we also check if we try different sectorial aggregations to define who's competing with you directly. And also we do this with the ask wage data as opposed to the transaction with the history of jobs. Okay, so now the last thing we do is we use this data to measure or to provide a different measure of how easy or how offshore is a job in a particular occupation. So existing measures typically hinge on subjective judgments in the words of Kleiner and Kruger. So for example, this seminal paper of Kleiner and Kruger has two measures of how offshoreable is a job. The first one is just based on self-reporting. So they ask respondents whether your job can be done in a remote location, and if you say yes, then they're going to say your job is easily offshore, and if you say no, then it's going to be less easily offshore. And alternatively is to do some coding based on the job duties that the job entails. So, for example, if you use computer a lot and you spend your day on the phone, they're going to say, oh, your job is offshore. So there's kind of this implicit assumption that if something can be done remotely, then it's very offshore. We're going to do something different. So we have this data that tells you where the worker is and where the employer is, right? So we can actually know which jobs are being offshore. We're just going to use that data on cross-border contracts and say that a job is offshore if the employer's country is different from the worker's country. And then we're going to do this taking the US as a baseline. And then we're going to just say, oh, our measure is of offshoreability is what is the share of US jobs, meaning jobs where the employer is in the US, what is the share of those jobs that are actually offshore? Right, so these are measured. The denominator has all the jobs in occupation J, where the country of the employer is the US. And then the numerator is the jobs in occupation J, where the country of the employer is the US, but the country of the worker is not the US. Yeah.
That's like a lower bound, right?
A lower bound, meaning, yeah, in a sense, meaning more, yeah, so the word offshore, this is a thing about offshoreability in a sense. Yeah, potentially more stuff could be offshore in the future. So this is a measure of what jobs are being offshored now. So that's another way of putting.
Yeah, I thought something like a comparative advantage of comparing the ratio of the wages across occupations in different countries.
Okay.
And then, which is like the autarky prices in trade are very different. So then.
Okay, so let me rephrase that. So essentially, we have a measure of a trade share in a sense, right? And now we're going to show you in a second what the trade share looks like and how that varies across occupation. And of course, the trade share can change. It's like endogenous, right? And it can change because it's very hard to trade something, or it can change because there's a lot of comparative advantage, and our model has or any model with a CS demand is going to have an implication of what shapes the trade share. So I agree.
The comparative advantage and the transport cost, something like that.
Yeah. So that follows from our demand. Today, I cannot separate the two today. It would be good to tell you what it is. Yes.
Perhaps I missed this in the beginning. Platform is such that all the jobs are actually done remotely.
Yeah.
Then the answer to the question is 100% of the jobs. Many of them happen to be in the US, but they are all
sure.
I mean, the nature of the job is that they can be done remotely, and some are in different cities within the US, some are in cities in the US and in India, but they are all offshore.
Yeah. But the question is not which jobs can be done remotely. The jobs is which jobs are easy to offshore.
That's a question about this. I mean, I thought the nature of those surveys and stuff is it technologically feasible to do it, and then perhaps the relative prices are such that you do it.
Okay.
But I thought that's what those measures are trying to get at.
I know.
That's what I'm not. Yeah.
Okay, so maybe I should qualify what I'm saying. What you say, I guess at some prices, everything is technologically difficult to do it.
Being in front of you.
I have the point of view. You fly on Friday and you come back on Sunday. I'm doing it right now. Okay. But no, the more precise concept will be yes. So I want to show you what is being offshore today and how that relates. That one say, despite the fact that all this is more, what is being offshore today, right? And then you can say, well, this is more easily offshore, or this is going to change, and then tomorrow everything is going to be offshore. That is how it looks now. Okay, so which shops are more offshore? Maybe I should say here. Which shops are more offshore? Well, the most offshore jobs, the platform has to do with design, developers, translators. So of these occupations, like 90% of the jobs are in offshore. What is the least offshore? Well, maybe you would have guessed it. The ones that have to do with writing or with legal, those are mainly done by US workers. So these are only like 30% offshore. So what do we make from these? So the first measure would be like, well, the fact that something can be done remotely does not necessarily mean that it's being easily offshore. That can be easily offshore, or at least a large fraction of these jobs is not being offshore as of today. Even among occupations that are all remote, we do see a lot of heterogeneity in what is offshore. And then what we do in the paper is we provide a measure of this offshoreability for all the occupations that we have. Okay, so let me conclude. I guess I'm also early or undershoot. So we use new data from this web-based job platform to study remote wages. We show that there are large wage gaps in remote wages across workers that are located in different countries and regions, even though all of this is being done online. And the worker location accounts for like a third of the various workers. So this is the most important determinant, observable determinant of wage. So number two is that the remote wage, yes. The remote wages seem to be highly sensitive to foreign shocks. They respond very strongly to your own exchange rate, right? Because I showed you that the wage in dollars is not moving with the exchange rate, which means that your wage in pesos is moving almost one-to-one with your exchange rate. So that looks very different from local wage. It also responds to changes in foreign exchange rates and foreign inflation through the effect of these variables on your competitor's wage. So our estimates said, oh, if there's inflation in India and that increases the wages of Indian workers, that's going to affect everyone else's wages in the platform. Well, then elasticity was of almost 1. In a sense, these findings are somewhat similar to what we see for some tradable good prices, right? So in a sense, if you're not sure what to make of this market, what is like, it should look like a labor market, a local labor market, or it should look more like a market for tradable goods. The pass-through and the complementarities, meaning how much you respond to your competitors' wages, those are in line to the findings in the pass-through. And finally, we provide this new measure of how much we offshore these occupations, and we show there's a lot of variation even within occupations that are all remote. Yes?
So, the previous question, isn't that a measure of real comparative advantages rather than observability, right? I guess you can construct an index.
Yeah, so the trend share you can get from here if you want to look at it, and of course it can come from difference in trade costs or home bias or whatever, or difference in wages across occupations. What are the advantages? So far we're not treating this, right? We need to measure these things. We're not quite sure how we do it.
I think it's not observability in terms of following with the previous question, right? It's not all of this is technologically viable to be offshore. So I'm asking, is that rather a measure of revealed comparative advantage?
Or it's a measure of how high are trade costs in an occupation versus another? Or it's a measure of how much home bias there is?
And I guess you can see how that changed with the pandemic, right?
Yes, not yet, but hopefully.
What's the platform? On the left side.
I'm not to say,
Okay.
but you guess from the pictures. Alberto is the scraper. He does me. He's a legal.
You're saying you cannot construct that yet.
Yeah, so we're trying to scrape it again on the page. But this is all. Right.
Okay. Is it a region within a country? The city, right?
Yes, it's a city. Yes, so it would be nice to do this by city. We need like GDP per capita on cities or something. Maybe that's it.
Thanks.
Pero no creo que lo otro que hace es que ayuda un poco a motivar el movimiento de
Yo también, a mí me llegó, a ella no, y no lo sé. La relación entre la elasticidad y la oferta y demanda tiene que estar y después hay no, aparte, si me no voy a dejar porque la grabado, no me están entrando. No, llego a casa y yo dije no, yo justo estaba en el de seguridad, pero no, nada, tengo que todo.
No, creo que no tenga Wex, que bueno, después puede decir eterna en la línea, la mía que esto, que crezca la gente que trabaja online, deberíamos los exchanges, que los sueldos necesitan los que se mueven con exchanges de una manera distinta que los sueldos de la gente que
sí, a veces que me conecté siempre a los seminarios de los miércoles que
después tenés de vuelta, todo depende de por otro lado
se pueden hacer igual que se
¿Qué hace, señor? Hay un sentido en donde decimos, bueno, ahí va.
Yo digo, nivelado.
Le pasa que es una ventaja de California.
Otra porque la más libre.
Ahora se lograron.
Quizás eso parte de
Escribió una chica, hay chance de
No, el primero es de donde hay la gente, creo que es más como. Al menos los primeros dos, quedó cosas. Una en Argentina, 10 años.
No, pasa que una estaba conectada y
Los años argentinos, ¿qué pasa si mañana la revalúa? Otra cosa,
no, pues sí,
pero creo que es lo que
si yo
Tienes que cierta forma no podemos explicar el rollo separado del tema, ¿no? Porque puede ser que sean super sagas, pero que también, si vos pones de paso una más niños,
Qué gusto compartir con
¿cómo vender? O sea, ¿cuál es el mal? Oye, como escucho, no te hago una pregunta. Yo creo que no sé cuál es el impacto de no sé por lo que nadie lo sabe.
Tenemos que ver dónde lo vamos a mandar.
Y esto con los wages cambian según lo que vive la gente. No sé cuál es
allá en la parte de lo mismo, y el ver que están diciendo, pero no, ¿hasta qué punto?
Es lo mismo.
Se lo mandamos cierto a PIR y al es una pena, porque yo creo que el día que le den una chance que algún preferido lo vean y
Ok, pero hecho así, serías que estaría hablando como.
¿Qué es lo que pasa?
O varios más.
¿Qué frecuencia?
Por razón, yo me perdido, yo no voy a pasar. ¿Cuánto llevas pensando?
Al final
Fue.
por eso.
A mí se me pasaban las pasas que
esto le entró en la chance. Fue un crítico.
Si seguimos bajando, podemos.
Que llegue la aplicación de Nara, no va a ser por esto, no es por esto, por eso por los tres.
Te decir esto me parece rápida.
Igual. De hecho,
Mañana te
Bueno, mi modelo
Ahí firma Machinea. Está ahí en el libro de ahora está en cuando ahora hace una especie de
de hecho, hay una
no, que Machinea feminista.
En ese caso tenés obviamente ustedes en la gerencia
Okay, let's get started. Thank you, Joaquín. You have 1 hour.
Right, thank you so much for putting the paper in the program. It's always very nice to be here. This is joint work with David Atkin, Pablo, who's in the audience, and with those Hospital.
We're going to say that all errors are fixed.
What? Exactly, all errors are there, or that's part of the rule. Okay, so I guess it's I don't have to motivate in this room very much that it's well known that governments often rely on discretionary trade policies, that is, policies that favor or punish particular sectors or firms. For example, differential enforcement of regulations, subsidies, local content restrictions, import licenses, tariff exemptions. There's a host of these things that are like we believe they're very often used, very commonly used, and that's we see they're kind of hard to measure. So it is difficult to estimate usually the determinants and the consequences of these policies. And I guess one can talk a lot about this, but to summarize, basically governments are not very keen on publicizing these actions. Effectively, for example, because they are actually illegal according to the WTO. And even if that's not true, it's pretty hard to quantify non-tariff trade barriers. These are often non-tariff form. So, constructing measures of these things, it's not that easy, it's imperfect, etc. Now, zooming out a little bit, regardless of discretionary trade policy, in general, I think regardless of the motivation of trade policy, be it like maximizing national income, redistribution, political economy considerations, it's fair to say that the terms of trade effects of the policies are going to be very important for the aggregate outcomes. However, believe it or not, the evidence on price effects is still pretty scant, pretty rare, particularly from less developed countries and particularly the non-tariff barriers. Okay, so here we enter. So in this project, we're going to study trade policy in Argentina between 2012 and 15, which is a pretty rare episode in the sense that we have a government that, and we all know it's flagrantly violating WTO, yet keeping very detailed records of it, as we will see now. So it's a pretty unusual, it's fair to say it's an unusual policy experiment where there is variation in transaction level trade restrictions. And we're actually going to have access to a database with the universe of international trade transactions, where we're going to see at the shipment level what importers were requesting and what decisions, what the decisions were, like the fraction of value approved. And then what happened, then we're going to get customs data. We're going to see what actually went into the country, quantities, prices, like standard custom data linked to this. So we believe that's pretty rare. So the first thing I want to show you, which we think, as far as we know, is pretty novel, is there's going to be a connection between, going to the determinants of trade policy. We actually find a pretty close connection between macro imbalances, think of like reserves fluctuating at like high frequency or like relatively high frequency, and the level of overall protection, and also the dispersion of protection across sectors. We're going to see that the government did not treat everybody equally. And there's going to be kind of sort of an interaction. When they had to tighten trade policy, they didn't do it uniformly across sectors. They had pretty clear preferences, and we're going to use that, down the road. But just like documenting this, we thought it was interesting, making the connection. Okay, we're going to actually focus, like for now, in quantities and prices, and you're going to see unexpectedly. Yes, the policy did manage to lower import quantities. That's not so surprising, perhaps. But we actually encounter a pretty unexpected empirical result as far as we think, which is that these restrictions actually managed to increase import prices at the transaction level. So effectively, importers were buying less and paying more. And we think that's surprising because at least our prior was that these trade policies, were shifting around import demand in Argentina, not export supply. For a country like Argentina, we wouldn't imagine that would affect world markets. And so if you shift around import demand, you're moving along the supply curve, and then you would have a positive relationship between quantities and prices, not a negative one. So for us, that was surprising. And also in the literature, typically, I won't have time to talk about the literature, but typically in the case of tariffs, the rationale for tariffs is to improve the terms of trade. And so to some extent, empirical papers find that, or maybe they don't find an effect, but having like this backfiring effect is pretty rare.
But that's consistent with the suppliers facing more uncertainty and restricting their supply, right?
Sorry, can you just repeat that?
So I think the third fact is consistent with having foreign suppliers restricting their supply in Argentina because of uncertainty.
Yes, possibly. Exactly. You will need to have something affecting the foreign supply. Maybe that could be a challenge. Sure.
Or the supplier colluding with the importer to over-invoice and take advantage of the dual exchange rates.
Okay. This we haven't thought about.
This is the obvious thing.
I don't know to what extent that was like a systematic feature of the data, but we can try and see. I don't know.
The incentives are huge.
Yeah, we'll
and
see.
they tighten when
So how does that work? You inflate the request, or
when you're allowed to import, you can buy today. It will be imports dollars, tradable goods, paying 100 pesos per dollar, and then you can sell. It's like buying dollars at 100 instead of 200.
Yeah, but you import the goods.
You import the good for half the price.
Yeah.
So make an arrangement with the supplier.
Okay, possibly. I mean, I don't know if that's a systematic feature of. I mean, I'm sure to some extent that was going on, but whether this is, we're going to have data on the entire economy. Okay. And so basically, our way to do that, to like link demand and supply, is going to be very simple. Today we're going to have like almost like a toy model just to drive this point home. If you think of a model where there's bargaining between an importer and a foreign supplier, then depending on the bargaining, so the price is going to be somewhat between marginal cost and the demand in Argentina, right? So depending on this weights, it's going to be it's going to be a weighted average between these two points. And if the foreign supplier has a lot of market power, or sorry, a lot of bargaining power, then the price is going to be close to the demand for the good in Argentina, which is downward sloping. And that's one way to get it. And that's not the canonical model we use to think about international trade transactions. And so it's like an interaction between trade policy and market power. But the disclaimer is the second time we present, so it's pretty preliminary still. So today I'm going to show you like mostly facts, a little bit of the model, and you see, I mean, we're going to actually use the model quite a bit, even though it's super simple, and it's going to be a building block in what we're doing next. I'll tell you a little bit about that at the end. So let me kind of skip this literature. Let me just say one thing, that from the theoretical point of view, this is obviously not new, that trade policy could interact with market power to yield this type of effects. But I think it was kind of considered like more like a theoretical curiosity, because most empirical studies of past tariffs pass-through or something like that were finding kind of the other type of effect. Okay, that you either improve your terms of trade or there's no effect. Okay, but not this. So we thought that was pretty surprising. So let me kind of, in the interest of time, I mean, I guess in this room I don't have to spend a lot of time with this, but nonetheless, just to put everybody in the same track. Let me just tell you a little bit about the context of what, just in Argentina, just right before, and then what the policy was, just to be on the same page. So after like strong growth after the crisis of 2002, the recovery, Argentina quickly found itself with a stagnating economy, with worsening current account, with currency controls, as you all know. And what I'm not sure if you know is that around 2009, Argentina already started meddling with trade policy. But the way, the form these took were non-automatic import licenses. So this is basically the government would decide if a particular HS8 or HS4 sector was subject or not to a non-automatic import license. These are, by the way, potentially legal according to WTO, but depends on how you do it. You have some time to respond. They're typically designed for like nuclear reactors or something like this, but Argentina was obviously not using it in this way. So around 2009, they started doing this. And so the way to quantify is that you could look at the number of products subject to these licenses, and it was kind of growing fast, and the value that they accounted was strong. Now, in February of 2012, the government like stepped up the game like massively. So in 2012, they actually implemented this system, the HIDE, or Declaración Jurada de Importación Anticipada, and like a sworn advanced declaration of importation, like this, that was very different. It applied to all the products that the country, that anybody wanted to import to the country. Firms had to request authorization in advance, okay, in advance. The government, and there were actually, there's a lot to this, there were 6 different agencies that could block the request. The most important one is the Secretary of Commerce, of course. And the decision could be a total block, a partial block, so you get like 30% of your quantity or value approved, or nothing. And then firms, well, I guess it's I don't think I have to motivate this here, that it was pretty discretionary. And then firms had a right to appeal. But let me say something from the get-go. So there is no place to look in Argentine law to see what the policy was or what the rationale was. This was introduced as a procedural change, basically a procedural regulation that you had to fill this form, and that's just procedures. But in practice, it was used in this way. So all we know comes from lawsuits at WTO, from Japan, United States against Argentina, that this is the way we can understand what was going on, or reading newspapers. So the government distributed these pamphlets among trade associations, telling them, okay, if you get blocked, just bring this documentation to us, and we will, you can appeal. And so because of that, we kind of know it was pretty clear. I mean, the government officials were pretty clear about the goals of the policy, and we all know them in this room. They were interested in trade balance, in import substitution, controlling local inflation, and investment. So these are the things that the firms had to come and show evidence of, like your pricing decisions for the last 3 years or something like this. At some point, I understand that they had an Excel file where the firms would submit an Excel file with investment plans for the coming years, and that would be a factor in the decision of the appeal. So it's pretty crazy. We couldn't get that data, so we tried.
Okay, is this a period of time when some firms were also required to export in order to import?
Yeah. Sorry. This is the firm level trade balance. Yeah, exactly.
So, do you know how is this interact with the FX controls? Once you were authorized by Commerce, you had the right to buy the FX at the efficient rate, or you needed an additional authorization of the central bank?
I think that's the former. I mean, the first thing you said, but I have to check. Okay, so what's the data? The nature of the data? As I said, we have the universe of transactions. We have quantities and values requested. That's kind of the new part. We can see what they wanted to bring, the importers, and then we see the decisions. We have that for 2013 to 2017. Notice that we're missing 1 year. That's because between 2012 and 13, things were done informally. This is Moreno. Things were done via email. Okay, but then somebody else came along, or he changed. I don't remember. Maybe for Costa. And then there was an electronic system. That's why we have this data. Okay, that's merged with standard customs data, so we actually see what went through. I mean, we see the realization, so we can see, okay, you got this value approved. What did you do with it? So we can test if these requests were inflated, and so we can do like lots of things because we see what went into the border.
And one of the scandals was that the containers were empty, but they got the effects anyway.
But I don't think that we will show up as an import.
No.
Right?
As a fake import. Anyway.
Yeah. Many of these things could be going on, but the question is how big in macro sense that is. I just don't know. Okay, we have importing. We have the name of the firm or an identifier of the firm. We have we don't see the brand. We don't see the actual name of the product, but we see an 11-digit identifier. We see the country of origin. We also use the measurement unit, kind of like these out and things. We match the data to Orbis or Dan Bradstreet to get like ownership information. We don't have a lot on the local side. We can match the data to see like sales, employment, like things that are standard in other countries. They're not standard here. So that I think we have a pretty good trade side, but the other firm characteristics are pretty limited, unfortunately. And then we have product level data for data. We have some vendors that typically sell bill of lading data. So actually, this is not product level. We also have like the customs data from Datamine and from Datamine, which is a vendor, and that's good because we can go back in time many years. We can do lots of things with this. Anyway, and then we have some local information about wage and labor from this sector level, from OED. Okay, and some of you are probably familiar. So I'm gonna, for a lot of the analysis, I'm gonna basically use variation between before the policy, the pre-period, the during period, which is 2012 to 15, and then the post period. So we have 2 years of data when Macri was elected. So just as context, what Macri did or his administration was they left in place the system. So importers still had to submit requests, but then they would approve everything immediately. So from the anatomy of the data is all the same. We just see you will see that approval rates went to 100%. But the database is a unique one, and we have 2 years of post period. So let me show you some basic stats. So for example, during the high period, we had 3.4 million requests per year with a mean value of 33,000. Strikes me as pretty low, I don't know. And here's the thing. On the average request, 70% was approved. So 30% denial rate on average, okay? And then post the high, right? When Macri came, you could see how this number jumps to almost 100%. Why is it 100? I don't exactly know. Okay, so then just to see that same information, this is not the same information because this was transaction level or request level. This is like macro, this is like the aggregate. This is the aggregate value approved and the aggregate value requested.
But go back to the previous one. I find surprising and really interesting the fact that the request went down big time.
Yeah.
The other thing that happened is that there was no more spread between the following, which is what Andy was saying. So that's a very sizable number. In a year, the economy was not going down. So there seems to be like 600,000.
No, but mechanically, I mean, hold on. You mean these numbers or the first row?
Yeah.
The thing is that there's some mechanical effect. So importers, sometimes we actually did this. I'm not going to show you today, but we have a way to link the histories. So you submit a request, you get rejected, and then you don't go home. You keep submitting. If you were approved immediately, maybe that story stops there. And so we see that on average, I don't remember, but maybe there were.
Try to clean that number from that.
Okay. Yeah, this is maybe possible.
So in the first column, you might have people asking 3-4 times the same request.
Yeah. Yes.
Okay.
But I don't have, so let's go to the next slide and say something about that. So this is the value of requests, and of the value of total requests, this is the value of total approvals, right? So you could say maybe the policy wasn't binding, maybe I just request twice and I always get 50%, and so I'm fine, I get what I want. So we're pretty sure that was not the case. So we have some, I'm not going to show you because of time, but we did some analysis where we show that the pass-through of $1 approved to $1 imported is almost 1 once you have at least, you need some variation in approvals. And then everything that I will show you today at the product level dimension will point to the fact that the policy was binding. We don't think that this was just, I guess it's not so controversial to say this policy was binding. They were not getting what they wanted. And then you could see, this match 1-to-1 after the policy. Question.
Do you have data about the delay between the request and the approval? Because I think there was something, a very long time between the request and the approval.
We have those dates, yes. Yeah. I don't have statistics, but we could compute them. I don't remember. Yeah, that's another, channel. Okay, so let me now focus, there's a lot of things one could do, and we're kind of there's unbounded things we can start looking at. This is so rich, but let me just focus for today, 2 features that we think are crucial, or 2 or 3 features. The first one is that actually, even though this could have been, in principle anything, we find that there were no partial approvals. So on the left, we have a histogram of the fraction of quantity or value that was approved, okay? And this histogram has mass in 2 points, 0 and 100. So it was an all or nothing decision. Yes, there is some mass here, 0.5, but effectively that's like peanuts. So this is the nature of the game here. So we're going to use this when we,
But maybe they spread because they know that it's 0, 1. They break. They have to import spare parts for a car, and instead of asking for one, I ask for many smaller batches, just to see how much they will approve.
Yeah, could be. I don't know.
I think that they did that.
I don't know to what extent. Yeah, I don't know. Yeah. So the second point that this actually comes more to what we do is that there's a pretty striking relationship between the likelihood of approval, full approval, right, and the quantity requested. This is going to be crucial for us. So here's a bin scatter of the probability of full approval regressed on the log of the quantity requested after residualizing for 11-digit product fixed effects. So it's these are residuals. And so we see this like very striking, like negatively typed relationship. So this is pretty telling. If you like request, this might be related to what you're saying. If you request a lot, then it's they might penalize you with the likelihood of it's much less likely that you will be approved. And so that's kind of where we start thinking this is going to be an important element in the theory of how the world is dissuading imports.
What's the axis there?
This is the log of the quantity requested, and this is
What's the quantity requested? The amount of
Value, right?
the value of request.
You could do it, yeah. We did it in two. This is quantity actually, but we tried both. Here it doesn't matter because it's fractions. Yeah.
You have the identity of the one that's requesting, because
Yeah.
you can see if it's requesting a lot, maybe it's splitting.
Possibly. One thing that we
can
have.
check.
Yeah, we can check. The other thing is that we did, I don't have it here, but we did some variance decomposition, like for the probability of approval. And the firm level fixed effects account for a lot. So the firm identity was, I'm not going to do much with that today, but we know that, who you were beyond your sector and things like that actually matter a lot for explaining that outcome. Okay? Question?
No, one thing. So one thing that goes against that intuition is you show that after the policy after 2016, the mean value was actually smaller. So you need to. I'm not constrained anymore of like this sending a request of like the smaller to be approved, like connected to that plot. So that's going on the opposite direction, right?
So maybe this
there's
will
a
help.
restriction. I can request a lot of a large amount and it will get approved. No?
Yeah, I agree. I mean, but it's 25, it's like a bit less. But this might help to your question. So this is we overlay now what happened after the policy. So all the mass goes to 100% with marketing, and this relationship becomes flat. So the system, was in place, but it was a sham. It was basically full approval and no penalty for the size. Okay, so we're going to take this seriously, this penalty for requests. Here's the other thing that I think might be interesting, which is this is a movement. So we actually document this link between the level of protection and international reserves, or the way the gap between formal and informal exchange rate looks pretty much the same. So we see that at the times where reserves were falling sharply, also this measure of trade policy, this aggregate trade policy measure was actually also falling, and these two series tend to move. I think actually this might be weekly data. I don't remember, or quarterly or weekly, but it's kind of pretty high frequency for trade papers. And so this is kind of, I don't know, I haven't seen this, but it seems to be like a link between these these macro imbalances and trade policy, going towards the determinants of the policy. But that's not all. We are actually going to leverage later the following, which is that there was a sectoral structure or dimension to this policy, which is that, for instance, let me just show you here. Here we have a regression of the approval rate of I think it's an HS4 sector on some pre-policy characteristics. So we're going to look at those sectors like back in time, like in 2011, and we're going to look at some characteristics motivated by the rhetoric of the government. So for example, the fraction of firms that are importing capital. So why would we do that? Well, we know that investment was important. We know that many Argentine firms, to invest, they need to import capital goods themselves. And so we can see if in a sector, there's a lot of importers of capital, that would be something that seems to be complying with what the government wanted. That correlates pretty strongly with subsequent approval rate during the policy in 2000.
What is this relation? The approval rate of the cross-section of sectors?
Exactly. So these are like, this is the cross-sectional relationship between approval rates and pre-policy characteristics of sectors. And we look at three. Let me ignore this one because of time. The fraction of capital importer, the fraction of firms that are capital importers, and then the fraction of firms that are exporters, going back to the trade balance thing. We know that we're really obsessed with that. So sectors where importers were also exporters, they also feature a higher approval rate. So we're actually going to leverage this by combining down the road these two dimensions, the time series dimension, that when at some point reserves were really collapsing, they had to tighten the belt here, or the trade policy, but they would not do it uniformly. They had kind of preferences, and they were pretty vocal about what those were. Okay, so going back to the, again, before showing the model, let me kind of, as a first pass on two key outcomes, give you a first pass on two key outcomes of interest, which are prices and quantities, right? Pretty natural. So these are, so we first here we do some regressions of log prices and log quantities on firm product fixed effects. By the way, firm products are triplets of HS11, country of origin, and measurement units, so super narrow, interactive with firm. And then we also put year fixed effects. And here I'm plotting the year fixed effects. So think of these as patterns for prices and quantities within firm product narrowly defined. We see that during this period, we see this macro fact, which is that quantities were depressed. Okay, no surprise, they really wanted this, right? That was the outcome. But here's the sort of, we're going towards that surprising fact that prices were elevated. And then to try to link this a bit more towards the policy, we do that regression, but breaking down products into 4 groups according to the approval ratio that they had during the policy. Okay, so every sector gets classified into one of these 4 groups. Okay, the membership in the group is fixed, and then we plot those time residuals. The red is the one with the lowest approval ratio, the sectors that were more hit. We see that the quantities were falling more when your approval rate was kind of lower, okay? And then prices was rising more. And there seems to be like a monotone relation between these things. So it's kind of promising for the idea that this might have been related to the policy, okay? As opposed to like pre-trends or things in international markets with prices and so on. Okay, so
these are mostly intermediate inputs, right?
I think generically, yes. I haven't checked the fractions, but typically 2/3 of world trade is inputs.
And you have like local prices? What happened with the markup over the cost of the import?
No, but there is some hope at some point. For some sectors, we had kind of hope of getting Nielsen data for supermarket data and try to link it. But it's very hard because one is at we don't have the brand name, so the matching we tried this, but it was very rough. So I can't really promise we will actually deliver on that. It would be awesome if that would be possible. But anyway, so let me show you like a toy model, like literally a toy model of how we think about this policy, and then think of this as kind of a building block into a richer model that will come later, not today though. So think about an importer in Argentina that has a linear technology. They import an input, a widget, and they transform it into output with linear technology, like 1-to-1. And then they sell it at this demand. We face this demand in Argentina, which is downward sloping, right, with elasticity sigma. Okay? Then imagine there's a foreign exporter out there that has the following marginal cost. Okay, so marginal cost is increasing in quantity with rate, with elasticity eta, and then Z is a supply shock, and by the way, A is a demand shock. Okay? And then think about the following kind of game or timing. So there's a match, there's an importer-exporter match. Then the way we're going to think about it today is like they first decide jointly on the quantity. Turns out it won't matter who chooses the quantity. Then they submit this, somebody submits it to the government. That gets approved or not with the probability alpha that depends on the quantity requested. Then the firms decide how they can import any quantity up to that approved, if there's an approval up to the requested amount. And then there's going to be Nash bargaining over surplus to determine the transfer, the price. with weight beta on the importer. Okay, and by the way, we parameterize just for to deliver some close-term results. This alpha function, the probability of full approval, is just an isoelastic function of the quantity requested, where we have two parameters. The more important for today will be this phi, which is the the penalty parameter. Like how much was your probability of approval decreasing as you increase your request, the size of your request. And then we have phi 0, which is a parameter that affects uniformly the probability of approval, regardless of how much you request. Okay, so pretty simple.
So you're saying the procedure is that we followed was you submit quantity, not the amount of currency you need?
Yeah, so it turns out that we try to solve this one. It's a bit more convoluted if you put the value requested. And so we think that some...
So this is the model. The reality was you said how many dollars you needed, right?
I think that's fair. Yeah. Yes.
P times Q.
Probably, I think that might be a better model. It's just that this one gets more complicated quickly and doesn't deliver the sharp results we get. So I have to talk to you later about that. But essentially, I think that's a fair point.
The request has information on both.
Exactly. The request would, yeah. So the data has it. We see it.
Yeah.
Just the model doesn't.
That's why I asked now.
Yeah. Perfect.
I thought it was value, but now you were modeling it this way. Okay.
Yeah.
But I mean, again, to the government, you gave both P and Q. Then the government decides what.
Right, but now I think his point is in the model, the decision is just a factor of
the model.
The model.
Yeah. It's not that you just gave the value. No. You gave the two.
I can't hear you.
Oh yeah. So okay, this is a good point. In reality, the importer submitted a value, but also a quantity.
Right.
So we don't know what the government. So this would be actually the right model. I mean, how do we know? I like your model. I think you're right. I agree with you. It's more, they were interested in currency, so they would be interested in P times Q probably. So I would choose that model over this one. True, but we don't really know exactly which one it is. It's a black box, right? Okay, so the model is like trivial to solve. Let's start from the end. Given a quantity, there's Nash bargaining with weight data. So this is the optimal transfer P solves this simple problem, and it's kind of like in one step, 2 lines. You find that the optimal transfer is a weighted average of 2 things. Number one, the marginal cost schedule, which is increasing in Q, with weight beta, which is that's what the importer wants. The importer wants to put price as low as possible, which is the marginal cost. But the exporter wants to put with what weight 1 minus beta to put price as high as possible, which is the demand, and that one is downward sloping in Q. So you can see already here, it's not just a conclusion, that depending on beta, you could get this, you could get a relationship between P and Q that goes in either direction.
I'm sorry to miss this, but do you have the foreign firm ID in the data? They're modeling as a single firm, like the foreign.
Yes, we don't use it now, but we might have it for some subsectors. It's not something that comes in the full data. So we don't know exactly who the supplier is in general.
So you actually observe a price of a product at 11 digits, but do you know how many firms are, or within a year, how many firms are supplying that product?
Out there in world markets?
In Argentina.
In Argentina?
Yes.
Sorry, I don't understand. So we see that for the supplier?
You see the supplier, basically.
I don't know the name of the supplier, but I know this is one shipment that happened with one supplier, not with many. It's not aggregated. It's like a flow level data. We just don't have the name, and if we had the name for all the firms, we could match it, and get some more information on the supplier. For now, let's say we cannot do this.
We should think of the model it's a model about one transaction.
Yes, it's a model of one transaction, exactly. Okay, perfect. So then if you put this back into the, so then basically if you go one step before, the quantity requested actually turns out to maximize expected surplus. Okay, so it's efficient. This is a property of this model. And so what's that? That's basically expected surplus of this relationship. It's just alpha, the probability of approval of function of Q, times the profit function in the undistorted case. And just think about it. Alpha of Q is just shifting the profit function to the left in some sense, but in a tilted way because alpha depends on Q. Okay, so when you solve for the optimal Q, naturally the penalty parameter, that exponent in the alpha function shows up there, but not the alpha 0 in this basic model. Okay, in subsequent future versions, we're actually going to bring back the phi 0 here. We can talk about data, but For now, simple model is just that. And so there's kind of three simple kind of things we're going to take out from this model. The first one is trivial, I just said it. Basically, when the penalty parameter went up, quantity requested went down. Sorry, down.
That's the approval rate.
That's the approval rate? No.
What's the penalty?
Fee, exactly. So that's a good point.
The elasticity.
Exactly. So the approval rate will depend on both phi and equilibrium or observed quantities. But here we're just doing comparative stats with respect to phi mostly today.
Okay.
Okay. Because that's the way. So the model tells us if this is very simple. If you take this model like literally, this is saying phi 0 doesn't matter. The one that matters is phi. Because phi 0 moves the probability function in a uniform way. So who cares? You're still going to do the best you can. That's the optimal. But phi distorts that choice in that way. So that's why you get that result. So you have to tighten the policy in the phi, in the exponent part. Okay, the penalty parameter. Then, when it comes to prices, the effect of the policy on the price can be positive as long as the weight of the foreign firm is high enough. The bargaining power, so beta has to be low. That's the weight on the importer. So the power of the foreign supplier has to be low enough. And you know how low depends on the shape of demand and supply. But that's the point. And so this result says that an increase in phi will increase prices under that condition. And put differently, if you think of the policy as something distinct from supply and demand shocks that is shifting around quantities, then this policy will induce a negative relationship between prices and quantities. Okay, let me say it like that, and you'll see what I mean later. But that can happen. And then the last point is a bit subtle, but basically, regardless of the sign of this first derivative that I just said, regardless of the sign, what is true is that the change. So the magnitude of this derivative goes up with beta, even if it's negative, because goes down with beta. So if you give more weight to the foreign supplier, you're putting more weight on that demand level, the demand function in the transfer, and that's decreasing. So basically, in quantity. So basically, this effect is going to be stronger if the foreign supplier has more market power. Even if this is not positive, you're still going to get an increase in this derivative. Okay, so I see that it's a bit convoluted, but it's actually we're going to find support from that in the data. So I put it here now. But the other thing that the model says is that because beta doesn't show up in the optimal quantity here, then actually the second derivative is positive, is 0. So when it comes to quantities, beta doesn't mediate the relationship between the policy and quantities, but it does mediate the one with prices. So very simple model. So let's kind of try to bring it to the data. So there's kind of many ways to do it, but
you're doing this because theta is going to be some number and then it's going to be 0 in the post period, right? That's the reason you are doing this.
Theta is 0 in the pre-period. It goes to a number, and then it goes to
0.
Essentially,
okay,
0.
Okay,
exactly. And I can show you exactly.
You are doing that.
Yes. And I'll show you exactly what number. I mean, you see. So the first, we're going to actually bring this model to data in the following way today, which is exploit variation in the policy, in the stringency of the policy across products, narrowly defined 4-digit products, and also time. Time is going to be two things, either policy periods, or actually we have this new analysis where we look at within the policy kind of quarterly variation. So we'll see what that means next. But what we did is the 2 steps. First, we need to estimate the penalty parameter 5, and then we're gonna see how that relates to prices and quantities, and we're gonna do some empirics there. So let me show you. So we estimate the following. We take the following approach here. So for 5, we regress an indicator of whether the quantity requested equals the quantity approved. Here, F is a firm, I is this product thing, okay, 11-digit, country of origin, measurement unit, so very narrow. And T here is going to be, depends on the exercise, but now T, fixed ideas, T is a, so here, T is a month of sample. So this, we're going to be doing this exercise for the policy period and then for the post period, because in the pre-period, there's no request, there was just didn't exist, okay? So we have requests only in those 2 periods. So, so then this is a log. This dummy is a log linear kind of model of there's an intercept here. That is the phi 0, and then the phi, okay, is the coefficient for the log quantity, and then we're going to allow this to vary by product. So here H, let's call that sector. I think no product is an HS4 product. don't get confused with these ones that are the I11 digit. So the phi's, we estimate 2 phi's for each of the 4-digit sectors in the data. Okay, not at the 11 digit, that's a bit too much. Okay, so, and we do that for the policy period and for the post period. Okay, so what do we get? We get, here's a histogram. Let's focus actually for today on the size penalty. This is what Emilio was asking. Here we have a histogram of the recovered, a histogram of the estimated phi's at the 4-digit level. I mean, it's not on the graph, but the median is around 0.04. So that's the elasticity. Okay, so if you increase the quantity requested or the value, I think, I don't remember, but this is, so there's a 4% reduction in the likelihood of full approval.
So that's by sector?
Sorry? Yes, this is across sectors within the high period. Then we have the phi 0 there. So there's also variation in this like across the board parameter, phi 0. And then, boom, when macro comes, this histogram now shifts to like massively all the mass at 0, and here all the mass at 1. So essentially the policy was in place, but everything was going through. Okay, so this is the first step. So we have these estimated phi's, and they're not the same across sectors. Okay, that's kind of crucial. Okay, so now let's do the analysis kind of similar, sort of a similar plot to what we did before. Let's kind of look again at to prices and quantities, but rather than classifying by the approval ratio, let's classify by this phi, because the theory says it's the phi that matters. And this again lines up pretty well. The sectors with the highest penalty parameter phi saw the largest decrease in quantity and highest increase in price. Okay, so how do we do this in a bit more rigorous way? We take the following approach. There's different ways to do it, but this is the one we do. So we're going to regress the changes in prices, import prices, on the changes in import quantities, instrumenting the quantities with the changes in the policy. Okay, I know you could worry that it's endogenous. We're going to try to deal with that later. But the idea, that proposition that I showed you, those results, basically said that if you have changes in quantity induced by the changes in the policy, and assume for now they're not related to supply and demand, then you will get a negative relationship between price and quantity. That's what the model says. But along the way, we're going to actually basically regress these on policy and Q on policy also. So you will see it both ways. And we have a firm product fixed effects, year fixed effects. And I think I said that it's better to just see the table. So the first column, we call it first stage, but it's just basically a regression of changes in quantity imported. Okay. Remember, what the change with respect to what? Between there's 3 periods, pre, during, post. So we have like 2 deltas in some sense. And the quantity would be like an average quantity in that period for that firm and product and so on. So if you regress the change in the quantity on the change in the policy in the estimated phi, you get a negative. That's kind of the first result I show you. Sectors where the phi increased saw decreases in quantities by more. Okay, so that's kind of consistent with that proposition. And then now look at the fourth column. This just says that there's a negative relationship between the changes in quantity induced by these changes in phi and the changes in prices. If you like when we got the reduced form, just regress the changes in prices on the policy. Sorry, here. The changes in prices in the policy, and you get the positive coefficient. So sectors where the government was like applying a more stringent, a higher penalty parameter. So this particular dimension of the policy saw a greater increase in terms of trade. Okay, and that's kind of the part that we think is kind of, in that sense, the policy is backfiring. You're getting less quantities and higher prices. And so that seems to be not worthy.
So this is just data, right?
Just data.
And the question is, how do we know it's not that we just started importing more expensive, higher quality goods?
When this happened.
Right. Basically, when they tightened, we knew we wouldn't get all the imports, and somehow the ones that were less suitable with the home goods, higher quality goods, higher prices.
But do you think that's plausible? That's what's happening? I don't know.
No, my hunch is that
I don't know.
There was quality upgrading this period.
Only note there is that the level of these regressions is HS 10 or 11.
Yeah, you would need to get quality upgrading within an HS 10 It's not impossible. I just don't think that was happening.
I thought your E was a
Right, so the,
4-digit number.
yeah, but the variation is within HS.
We have these fixed effects. This I is a triplet of a country of origin. So you need to operate quality within an 11-digit product coming from Croatia, and well, the measurement unit too. But I cannot rule it out. Maybe there's a way.
Could be,
Could be.
that you don't have barcodes?
No, we don't have barcode. That would be amazing. So we don't have the brand or a barcode. Okay, so how much time do I have? I didn't record.
2 minutes.
Follow up with this question. This is
5.
15 minutes.
15 is good.
this is substitution. So following with the question, this is substitution on the origin of the product at 11 digits for a given firm. So that might be an indication of quality if you check the type of the country where it's coming from as a proxy of quality.
Okay, and kind of relaxing these effects.
Yes.
Yes. Assuming that richer countries have high quality. Yeah. We could try. Thank you. That's a good idea. Okay, so then the question is, okay, maybe these changes in policy were endogenous, right? I mean, so maybe the policymaker was kind of deciding the phi as a function of Q or P, and that's kind of the way it is. So what we do in that regard is we rely on on that motivating evidence I did at the beginning. So we know that when in bad times, when reserves were really falling, the government was kind of turning making import restrictions more tight. They had to tighten the belt there, but not uniformly across sectors. So we build the following kind of instrument. We interact the change in reserves, okay, times a sectoral characteristic. In this case, I'm showing you the fraction of importers that were also importing capital goods in 2011. So it's a pre-policy characteristic interacting with the change in reserves. So what I'm showing you here is first is the change in reserves in these very big broad periods, pre to during to post. So this is not doing a whole lot right now, but I will show you quarterly variation coming up. And so here, so the idea so then we try to we predict the changes in policy with this instrument. And so what the results show there is that, yes, when reserves were falling, you had to increase the PHIs, and that's what was happening, but you would do it maybe less for sectors that comply in this sense. The same is true if you put the fraction of firms that were exporters and other things that correlate with local employment, etc. So the things that we know that the government care about. And so then we redo the same table, but rather than using the phi, we use the predicted PHIs according to that stage 0 that I showed you before. So here's the same table as I showed you before, and it doesn't really change much. So we get the same thing, okay? The policy reduced quantities and it increased price or generated this negative relationship between price and quantity. Okay. So that's kind of what the data is telling us at this stage. Now we're exploring this quarterly variation. Okay, it's a very different type of variation. So we basically do the same analysis, but regress. So the instrument is done with changes in software. Let me just say one thing. We need to re-estimate all the PHIs. The PHIs were estimated for a whole policy period or pre or post. So now we re-estimate these PHIs at the quarterly level within the high period. That's the first. I'm not showing you that, but that's kind of a lot of work is there. Then we come to this analysis and we repeat the same idea. We regress first the quarterly changes in phi on this change in reserve, quarterly change in reserve interacting with fraction of firms that are importing capital. And then we take the predicted PHIs and we run with the analysis before to just check how import quantities relate. So we find a negative relationship with the changes in phi predicted by this instrument and changes in quantity. And we find that the changes in quantity generated by the changes in the predicted changes in phi are negative related to price. So this is telling us that basically, again, this is all pointing towards market power on the exporter side. It's all qualitative now. Maybe in the future step, we can actually use these moments to kind of quantify data or by product and so on. But this is just qualitative at this stage. So these results imply high bargaining power of the foreign suppliers. We can extrapolate to other policies. This would be similar on the model side. If you have like basically quantity restrictions like quotas, you will get a very similar effect in theory. Also, pass-through of tariffs would be different in the model with bargaining. So once you identify the beta, it can change, because you might wonder, okay, so what's the interest for other countries? What do we learn about other policies? And I think we do learn. Once you know, if you really think this is a market structure and you have a number for beta or this, then you would apply to other policies. And let me just end in the following note in terms of mechanisms. Remember that third prediction, a more subtle one, about that the relationship between the policy parameter, the penalty parameter, and prices and quantities may depend on beta or not. Okay, so we test that. So we need a proxy for seller power, right? So here, basically, is the key. We use the number of other Argentine importers that are sourcing from a particular combination of HSA product and country of origin in the pre-period. So if there's a lot of Argentines kind of buying, buying the same in this kind of combo, then the foreign supplier has more bargaining power, would be the idea. And so then we interact the policy change with that measure of bargaining power, and we regress prices or quantities on that. And remember, according to the simple toy model, basically the interaction should be positive only when you regress prices, because for quantities, the beta was not there. Okay? So it turns out that that's pretty much informed by the data or in the data. So this is the interaction. So for prices, these are different specifications. Let's focus on here. We have a positive coefficient for the interaction, but for quantities, we don't. So it does seem that the changes in prices associated with the policy, regardless of their signs, are kind of higher, okay? Maybe more positive when the foreign supplier has more bargaining power. So there's maybe the beta is actually the mechanism. So what are we working on now, literally now? We want to have a richer model, obviously. So we're thinking of a dynamic model where, if you don't get approved, then you lose time. You just need to wait until you import. And so that would give a role for phi 0. That would also speak to the number of, we see in the data, we see the number of requests. We have these like nice plots where we see like how many iterations it took you to get an approval. And sometimes there's histories that never convert because you get rejected, and you just drop. So we have ways of linking that, seeing the duration, etc. And that has to matter, obviously, for welfare, it's going to matter. Entry, actually, I have a hidden slide, but sectors where the phi grew more actually show much lower entry, in the high period. So less firms became imported, or there was more exit or something like that. So we have, and that's going to obviously matter for welfare. So we want to put it in the model, and of course, we want to have a general equilibrium model with prices and so on, and get welfare. And the other thing is that we're planning to take this. So you might have wondered, okay, so there was a moment where I chose to test the theory and I went with products, and the phis were estimated at the product level. But you could say, why do that? Why not estimate the phis at the firm level? Sure, then you're going to have very few observations for each firm.
But do you have characteristics of the firm?
We have some. Like I showed you, I mean, of the firm, yes, we might have maybe overall imports or size. It's not great, but that's the hope.
I think that, I don't know for this period, but there is, people at the central bank merged the customs data with the data from the FJPs with the employer-employee things.
Oh.
And the credit database at the Banco Central with the quiz.
That would be very appealing. Yeah, exactly. But if we estimated the phis at the firm level, even though we can't really, I mean, we're going to have very high standard errors for each firm. I don't think we can test whether Coca-Cola's phi is this or that. That's not true. That's not probably possible to do. But we can then group firms by different characteristics, like their size, and do interactions with, like that. And that might be actually testable. And so that's kind of on the agenda. And I do not have a conclusion slide. So I don't know if that's, yes, the end.
Okay.
Yes. Thank you.
I strongly believe that
Ahora vamos a centrar primero, te pongo un precio para los que es el exceso de demanda, ¿no? Por el C, por como no se quieren parece porque no quieren que suba. Todos los precios nominales están subiendo, pero no quieren, emiten y no quieren inflación. Entonces es el exceso de demanda, pero no tienen la reserva. Después te ponen la excepción representativa acá. ¿Ok? Ya pues excedentes.
Pero
El consumidor es.
pero ¿cómo se genera? Ok, pero ahora mostrame cómo esto se genera.
El consumidor tiene que pagar esto.
Sí.
Costo nominal es este.
Son como ver.
No, claro, lo que pasa es que el importante es que está repartiendo esto.
Lo que tenemos, tu modelo es parecido al nuestro. En nuestro no hay luchada, no hay gaming, pero
Bueno,
claro,
y después
otro punto es que le pones eso. Tiene que ser suficiente peso. Nuestro punto
no. Lo que estamos viendo es esto. Estamos viendo esto. Sí. Esto con es una target premium. Porque el experimento ahí que no vamos a evaluar de checar la brecha. Entonces eso es un sustituto para rechazar.
Pero ese cambio de reserva funciona con ese market premium. O sea,
no, pero vos no estás usando el dato de precio.
Nosotros estamos en precio es la variable del lado izquierdo.
No, pero esta es otra cosa que es el dólar. Esa es una magnitud, es una medida de. ¿Cuándo abajo está ahí? Juntas el exceso de demanda, pues es una medida de cuán grande es el exceso.
Claro.
Que te que repartir. Yo digo que el incentivo dominante ahí. Hoy todo el mundo. En 2014 también la gente estaba comprando bienes durables a lo loco, porque sabías que iba a haber una devaluación, te estaban vendiendo a 10 lo que valía 15, ahora te ven a 100 lo que vale 200.
Sí. Claro, es que eso le pasa, que esa política, y ahora los premios
bueno,
hay una historia de bargaining, algo más que
no, es que vos no sabés cómo esa empresa que declararon.
Porque la regresión te dice que te bochaban más.
Está bien. No.
Vos podés pedir $1 trillón, pero nuestra data no dice.
No.
Bueno, tenemos las dos.
No, haces muchos chiquititos, los haces chiquititos.
Entonces es costly, porque no creo que, no sé si pueden hacer eso.
Hay mucho precio.
Después tenés que
yo conozco gente que yo sé que hacía textileros, que hacían un montón, y también sé que les pedían, vos pedís el over-invoicing, y después llegas a un red con el pedido, ¿cómo te repartís eso? O no, le pedís directamente que te cobre, te ponga un precio más alto, después no hacemos bien cómo lo hace.
¿Es posible que en aduana figure un precio y después el Banco Central? Esta plata es la que
No, yo te compro servicio de coautor, ¿ok?
Sí.
Y no te la dejáis, ¿no? Yo te digo a vos.
Yo no sé cómo
Sí, yo tampoco.
El Banco Central realmente hacía. Vos ahí me devolvés.
Vos no sos de Itela.
Los 5.
No sos de Itela, pero sabés mi día, ¿no? Bueno.
Esa es una respuesta. Después se puede pasar a algunos importadores chicos.
Oye, yo no vine a.
La otra cosa es.
No sé, tengo cerrado.
Otra cosa es la felicidad, o sea, nosotros vemos que hay 8 más, 8 más. Vos haces una gratis. El tabla te dice que hay una relación tight entre la prueba probability y el size, con lo cual hay una
Mata en
un óptimo. No es que diga un bounded total arriba.
No, vas a ver. Vos sabés que
Quería ir un rato antes
todo el quilombo por ser curioso. Era porque había
viaja a Bariloche, pues
vacío y hay un tipo de aduana.
se vaya a subir mucho al Chile o para que se vuelva.
No, claro, lo que
Si eso fuera todo,
Voy a ir ahora después.
no, lo que yo digo es que
Valero como el meo.
obviamente es pequeño.
Voy a.
¿Qué sé yo? No sé cómo hacer sobre un montón de cosas.
Estamos en Kibo, que son en la zona de lagos,
Transfer price. Por eso la manera que tiendes a por ahí los vehículos es la manera de sacar dividendos cuando están.
tenemos esto hecho por sectores. Se puede sacar un eso pasa
que tiene mucho.
Sí, no como tres. Ok, no, mira, si vos por ahí
tiene mucha actividad.
Toyota puede comprar
Kayaking, tiene un humito que sale siempre, pero no está muy activo.
si yo los puedo hacer Toyota comprar a Toyota de Francia, vení. Vos en Francia que cobra Toyota.
Eso es obvio.
¿Qué?
Digo, eso me parece que tenés que documentar que la gente no está tratando de resolver. Es muy rara la serie de macro, entiendo que time fixed effects, yo hago micro, no voy a mirar eso, pero
sí,
están casi constantes. Lo único que aumentó son los pedidos y cuando el dólar está demasiado barato. Básicamente, miremos el dólar.
O la brecha.
Eso es lo que te digo, miremos la brecha, que te lo están subsidiando, entonces suben los pedidos. Está el valor aprobado, la constante, y la gente por ahí.
Entonces está, hay mucho trade con firma relacionada con los multinacionales, obvio, pero también es con suppliers con esa confianza.
Ese es un miedo, es como un capital flight. Yo te compro dólares y después me los das cuando voy a Miami. Pues vos me
¿Vos te ves que Molino está haciendo eso?
No sé,
No,
Molino.
no,
Bueno,
no,
mostramos una realización Molino, pero puede ser, yo soy rentista, le compraba el instrumento
Molino,
para sacar
Molino,
caries de un pibe de Miami que labura hace 30 años y es mi primo.
Sí.
No, pero Molinos definitivamente, porque Molinos tiene una oferta en Miami.
Pero
Esto es capital flight.
Molinos tiene una
Lo mismo cuando, o sea,
Caimán.
las empresas quieren pagar, comprar dólares, quieren pagarle a.
Molinos se compra
Está totalmente regulado el mercado cambiario. Entonces vos
Miami Trading
comprar dólares es lo oficial.
En
Es
Miami
una forma de comprarlo.
compra las cosas
Das el precio y después cuando vas a Miami te dan la
y
isla.
después se las vende a Molinos a un precio más caro.
pero hay un trade-off, que el Banco Central te bocha más, por lo que mostramos.
relacionado con el policy.
Está bien, bueno, pero
Tampoco son dos, o sea,
no, güey, pero
Está correlacionado con la brecha.
El agregado.
sí, sí,
No,
pues,
no,
yo no digo, yo sé que
Cuando se habla de una muy barato lo están regalando, no lo quieren regalar en realidad.
Entiendo, pero la pregunta, o sea, acá es que hay una
porque
correlación entre el policy
parte del costo,
como el
parte
price
del-
inflation, pero
o sea, hay algo que entiendo
parte
que es-
de
eso no es, o sea, como que
se lo quiera
conectado esa relación.
o sea, yo no digo que ¿qué nos pasa? Yo no estoy para nada, yo sé que pasa,
Como que estas maniobras
pero estas regresiones te dicen que a nivel de las acciones tengo efectos fijos, o sea, es como que eso está pasando por todos lados.
¿Cómo?
Sí,
O sea, vos me estás diciendo los términos reales de intercambio no subieron. Es toda una
Pará, yo estaba explicando lo que decía él. Es
bueno, no
posible que vos te preocupes de eso.
a mí
No me parece
a mí me parece que
que estoy diciendo que me parece la aplicación
que
principal.
los términos de intercambio ya han cambiado.
Sí, me parece que la
Improbable.
explicación
Improbable. A mí me parece que es altamente improbable que el precio haya cambiado. Y me parece que es altamente probable que haya una maniobra entre empresas relacionadas para manipular el transfer price.
Pero tendría que ser masivo across the entire
No, pero lo
economy.
que no-
Porque lo miramos en sectores por acá, por allá, siempre ese efecto. Es muy,
No, pero
Pero es un macro effect.
¿Me puedo dar otra historia igual?
esta discusión, esto es el cross-section. O sea, yo en esa discusión que dicen agregado, pero esto tiene que estar correlacionada tu historia con lo que pasa en los sectores. O sea, la pregunta es por qué cuando te hago el trade policy más stringent.
Claro, o sea, matangas pasan más para el sector que por el sector estaba bien. Pero
Puede ser,
muy
te
convoluto.
tenés que preocupar igual.
Eso puede estar por debajo del debate.
Oye, pero la
A ver, ¿qué es lo que se
aplicación que a mí me divierte es
Todo
esta.
esto es una correlación
Que
entre.
Yo te hago,
Si
si vos importás poquito, te tengo que vender más caro.
y en esos productos.
No es
Pero ¿cómo le decimos
bargaining,
que es común?
simplemente
Bueno, no,
es difícil
no,
escribir esto en competitive, perfect competition. Sí, discounts.
Sí.
No,
Y si te estoy haciendo 5 encargos en un año, me haces un descuento, pero si me haces uno porque te bocharon 4, tengo que matar con el precio.
Esto te da.
Y yo tengo que conseguir el barco, eso. Todo lo que flete por ahí es un poco más costoso.
Este gap.
Lo que en general modelamos con ese cost, y eso te.
Esta marginal sagrada. Entonces,
No, o sea, es verdad que es incompatible igual con el típico modelo perfect competition, porque es increasing returns. Pero es una historia un poco diferente de estar sacando la cabeza y. Sí.
Pero la historia se casa
Podría ser totalmente cierto.
Creo que puede ser testeable.
Y si podrías ver la cantidad realizada.
Bueno, depende de todo.
Eso lo vemos. Eso lo vemos.
no, pero
Es independiente. Casi tendrías que ver si hubo otro shock de
vos
demanda
estás comprando el derecho.
y no era este. Y si eso también subió el precio.
Claro.
Tiene un regalo
Para decir que fue un
que es la brecha entre el tipo de cambio
Shock
oficial
de demanda, pero eso no te mueve por la oferta. Shock de demanda.
Claro, porque el punto es que la oferta es así en vez de así.
Eso me estoy diciendo.
Entonces cualquier shock, o sea,
Al no
no sé
ser
si
stronger,
tenés otro
se hace más fuerte en algunos
me
periodos.
hace pensar que si nadie encontró esto, pero miraban shocks de oferta, la verdad, sería algo para pensar.
tenés
Bueno,
el precio local del bien.
Tengo cosas que se pueden
Entiendo que puede haber con
entonces podemos linkear cuando hacemos un chip.
Pero.
No sé cómo que
O sea,
¿Qué es eso?
porque la oferta es como.
o sea, entiendo la historia de eso. Lo que me faltaría es cerrarla para correlacionarla con el policy.
Hay un mecanismo.
Bueno, interesante el proyecto, ¿eh?
Gracias por
Muy bueno.
Sí,
¿Es verdad?
sí, yo lo.
Me dijo que no.
con este.
No son contestaba tanto, pero no lo escuchaba porque con la máscara de ahí.
Es autor, muy fóbico. Es germofóbico.
No, pero decía triangulen porque yo no escucho.
Sí, pero creo que lo hice. Y llegué a una conclusión interesante.
Hay un mecanismo micro que es perfectamente compatible, que es con el trade policy uncertainty, que básicamente hay menos firmas en el mercado cuando vos tenés.
Sí.
Básicamente, si vos tenés un productor que está recibiendo
Pero eso
mucho.
acá dentro de mi cabeza es como yo, lo que hace el gobierno en Argentina te afecta la oferta, pero claro, bueno,
No es la oferta, la oferta de la Argentina. Entrando a
eso es
Argentina.
parte de nuestro modelo, pero
Sí, no, es compatible. No es más que, no es un bargaining, es una reduction. Un shift de
o sea, en la sección de mecanismos podríamos
Yo creo que eso es testeable, porque puedes mirar como un producto, la probabilidad específica del producto de que sea necesitado. Si hay variación, digamos, ¿qué haría un exportador? ¿Qué haría como fuera el producto?
O sea, mirar como una medida de riesgo a nivel produccional.
Hay temas de datos que no digo que sean copias verdaderas, seguro. La calidad, eso es que de alguna manera fijar si podés en una subset de la data.
Pero
El tema es
Gramatúricas.
claro, si
Pero no,
mostrás buenas
pero
paradigmas,
Andy me está diciendo que venían con el cargador vacío, con el container vacío, que los dólares. Está bien, pero eso no. Creo que eso se aplica sistemáticamente importación. Tenemos la data de aduana global, chequeamos con el IMF, tipo, hay cosas consistency que
no digo,
que
pero
todos containers
todas estas preguntas son como, bueno, es la data que tenés. Hemos verdad que nada. Mirando subsets de la data por ahí pueden de la calidad, por ejemplo.
Claro, esa
Puedes encontrar algún. Entonces vas a agarrar de lo mismo con eso. Ese bien lo que decís. Que estaba en Estados Unidos. Estos son como. Por papá de Javier, es diario.
Claro, chiquitito.
Grande acá, pero.
Bueno, vamos, Andy.
Son. Arms length con un motivo. Si podría ayudarlos a.
Andy. Okay, let's get started. Thanks, Federico. You have 1 hour.
Great. Thanks for having me in the program. The only non-Argentinian today, so I feel honored. I'm going to talk about spatial production networks. This is joined with Costas and Jueves, and given my affiliation to the central bank, the usual disclaimer applies. So the motivation for the project is that a key feature of a modern economy is the geographic complexity of production networks. So these production networks are fragmented across countries, regions, and firms. And this sort of idea has been coined, this idea of global value chains that has been shown to be kind of crucial for economic success, as recently shown, for example, by the World Bank report. There have been two approaches in the literature, a macro approach and a micro approach, that have been recently surveyed. On the one hand, in the macroeconomics, you have how the macroeconomic conditions determined by the production of the networks across countries and regions. And then you have the microeconomics of how firms form endogenous with these production networks. However, there's a limited understanding of how the macro and the micro approaches interact with each other, but also across countries and across regions. So that's where the paper is going to stand. We're going to study both empirically and theoretically the endogenous spatial network and study the macro implications of this network. For example, how do production networks endogenously arise across countries and regions from firm level decisions, so from the ground up? And then also, how do macro shocks endogenously shape these networks, and what are the aggregate and distributional effects of those shocks? So more in detail, we're going to build a micro-founded model of spatial production networks, where space is going to be municipalities in Chile and also other countries. Firms will search for consumers and also search and match with suppliers and buyers. This is going to have a tractable aggregation, and with this, we're going to characterize the aggregate gravity equation for trade flows, both the extensive and the intensive margin, an extensive margin in terms of number of relationship between regions, and also the positive properties of equilibrium, so uniqueness, sufficient statistics for counterfactuals, and so on. And finally, we'll study some normative properties and also the role of endogenous network in shaping the normative properties of such a model, and in particular, the welfare gains from trade. After the model, we're going to apply it to Chilean data. So we're going to use administrative firm-to-firm transaction level data, domestic firm-to-firm transaction level data from Chile. We're going to estimate the role of search and matching frictions and also trade frictions in shaping these spatial production networks, and study macro counterfactuals and see how the endogenous network amplifies or not the welfare gains from trade. So we're going to study impact on international trade shocks, but also impact of domestic transportation infrastructure in Chile. Okay, so in terms of the literature, besides the macro and the micro approach that I was mentioning, we have this recent literature on endogenous production network in space. It's sort of growing in the last couple of years. We're going to be closely related to Eating Portman Kramar's recent paper, and also Jueves' job market paper, and Graphy job market paper. The key feature in our model relative to their model is basically tractability and aggregation. It's going to be a really simple model in terms of how you aggregate up from firm level decisions, and that's going to provide a bunch of advantages in terms of predictions that the model has relative to the previous literature. Then we're also going to have a micro-founded gravity trade part of the model that's going to map to this literature and also the sufficient statistics approach, ACR type of calculation in the context of endogenous production networks. So we're going to show you how adding this endogeneity in the production network is going to change the predictions of this literature. And then finally, propagation of shocks in production network. This is obviously not an exhaustive list. There's been a lot of work studying this, and we're going to particularly focus on the endogeneity of the production network itself, the linkages of the production network, and how that's going to matter for how shocks propagate in an economy. Okay, so in terms of what I'll do today, I'm going to show you a bit about the data and motivating facts, just to sort of show you what we can do with the data, and then go to the model, quantitative aggregation, equilibrium, and then quantitative analysis. Okay, so let's start with the data and the motivating facts. So in terms of data from Chile, we're going to use this domestic firm-to-firm transaction level data. This comes from value-added tax collection purposes. It's collected by the Internal Revenue Service in Chile. The data started being collected, this new version of the data started being collected in 2005. This is electronically submitted receipts in firm-to-firm trade for all firm-to-firm trade in the economy. So it's going to cover the universe of domestic trade between firms. It's going to include information about the seller and the buyer, firm ID, the dates, the total amount, and the origin and destination location at the municipality level. Chile, we have like 345 level municipalities, and that's going to be the level of aggregation in terms of geography. We have other information here, such as prices. We're not going to use this today, but this is something that we'll sort of following where we're going to use. And then we'll combine that data with other more standard data. So we'll combine it with customs data that's going to give us import and export activity at the firm level. This is the usual customs data that you have in other countries. With firm balance sheet characteristics. So this is going to give us total sales of the firm and therefore sales to final customers as opposed to intermediate customers. And then also match employee data that's going to give us employment and wages. And this is part of a larger effort at the bank of sort of merging administrative data sets from basically all sources you can have in the state. And here we have sort of one preview of how nice it is, sort of merging tax data with customs data, labor data, and so on. But there's more coming, so stay tuned. Okay, so this is Chile. I have to put it, horizontal, otherwise, it would be too small. And here we have the different locations. The size of the location is in terms of population, and then we have all the trade between the locations in the country with some measure of trade intensity, just to show you that this data sort of spread out across the country.
I don't have a clue about how to read the graph.
So this is north, that's south. So here is Peru, and there's Patagonia and Argentina. Okay. Sorry about that. And Santiago is here, it's a big boat here. Valparaiso and Viña, the coast here. So the other big city is Concepcion down here. And the copper mines in Chile are here in the north.
So each dot is a city?
Each dot is it's a
and
city.
Each line is trade?
Each line is trade between the two locations. And the color is going to give you something about intensity in terms of how much trade there is between two locations.
The color of the dot?
The color of the line. So a line can go from red to blue.
Okay.
Just to show you a bit of the richness of the data. Okay, so in terms of motivating facts, first we're going to show that the number of domestic suppliers and buyers per firm is correlated with both firms' geographic location, say population density, and also firm size. That's the first fact. The second fact is that the number of supplier-buyer relationships between municipalities, so that is the extensive margin, and the volume of transaction per relationship, that is the intensive margin, is going to decay in geographic distance, but at different rates. And the third fact is that the domestic firm network linkages increase with a global import cost shock. Okay, so I'm going to walk you through these facts, but just to kind of give you some expectations of this, we're going to use fact 1 and 2 to kind of flexibly fit it into the model. So the model is going to be able to flexibly fit these two features. And then we're going to use this third fact to estimate some of the structural parameters of the model later on.
Clarification. So for each firm, a buyer and a seller, they are other firms, right? All are other firms.
So say that again.
Buyer of a firm is another firm.
Yeah, so this is how I partner. I mean, you can be a buyer and a supplier at the same time, and we see both sides of the transaction.
All right, but these are all firms. It's not that you have data final sales to consumers.
No, this is only between firms. Yeah, exactly. Okay, so let's go to the first fact. So on the left-hand side, I'm showing you at the location level. So this is, again, 345 municipalities. On the x-axis, you have the population density of the municipality. This is, a population per square kilometers. And on the y-axis, you have the average number of links per firm that firms in the location have, both on buyers, so that's going to be the green squares, and suppliers, which are going to be the blue circle. So what I just want to show here is that there's a positive relationship. In places in which there's more density, there's going to be more links per firm. And the second fact on the right-hand side is sort of similar spirit, but now at the firm level. On the y-axis, we're going to have the number of links that the firm has, both in terms of number of customers and number of suppliers. And on the x-axis, we're going to have the total size of the firm measured in terms of total sales. And again, there's a positive correlation. Bigger firms have more links. So what we're going to say with this is that both sort of a measure of productivity or size of the firm and also the geographic characteristics of the geographic location of the firm is going to matter for determining how many links a firm have. And we're going to, again, make the model speak to these facts directly. The second fact is how the intensive and extensive margin sort of vary with distance, with geography. So here we're going to run a very simple regression, a gravity regression. We're going to have on the left-hand side either the total flows between two locations, two municipalities, I and J, and we're going to project that on a measure of distance and also an origin and destination effect. And then just a residual, we're going to do that with total flows, with the intensive margin, which is going to be the volume per relationship, and the extensive margin, which is going to be the number of relationships. What you find with total flows is that there's a negative relationship, either whether you measure directly distance as kilometers or if you measure in terms of time travel. But what's important is that the slope with distance is going to be larger in the extensive margin than the intensive margin. So the number, again, this is what I said before, but just to recap, the number of supply-buyer relationships in the extensive margin are going to decay in geographic distance, but at a different rate than how the intensive margin decays in distance. And again, we're going to make the model speak to this fact directly, and I'm going to show you how you can reconcile this with our model. And finally, the third fact, which we're going to use to estimate the model, is how these domestic links respond to international shocks. So for that, we're gonna run firm level regressions with an import shock, which we're gonna measure as a ship share sort of a type of shock, where for any given firm, you're gonna measure a weight that has to do with how much of the import of the firm comes from a particular country and a particular product K at time 0 sometime in the past. So it's going to be the share, and the shift is going to be the total amount of world export supply of that particular country and product to the rest of the world, excluding Chile. And that's going to be sort of the shift that's going to move around sort of the incentives that the firm has in that particular market. So, this we're measuring in terms of flow. So if this goes up, that's something good for the firm. That's correlated with a decline in the prices of imports that the firm has. And so this is sort of taken off the shelf. And what we show with this import shift here shock is that first, the total sales of the firm go up, which is sort of consistent with this idea that this is a positive productivity shock. But what's important for us is that we also see that the number of domestic suppliers that the firm has, the number of domestic links with suppliers that the firm has, also goes up. It goes up significantly. So we're going to take this feature of the data, saying that first of all, the number of links that you have domestically is going to respond to these international shocks. So the endogenous margin of these linkages is important as a response to these shocks. And second, that there seems to be gross complementarity between foreign shocks and domestic linkages. And again, we're going to make the model speak to that fact directly. Ex ante, you can write a model that gives you gross complementarity or substitutability. We're going to show you what features of the model is going to drive this gross complementarity. Okay, so that's the facts and the data. So I can go into the model unless there's a question. Okay, great. Let's go to the model. So space is going to be partitioned by a finite number of locations. So we're going to call locations either I or U for upstream and B for downstream.
going to be a set N location. There's a continuum of workers of measure Li in each location. There's going to be a wage, a local wage. And there's going to be CS preferences of these workers. There are going to be two types of goods, intermediate goods and final goods. The intermediate goods are going to be traded across locations subject to a bilateral trade cost, tau, UD. And the final goods are only going to be traded locally, so within a location. Firms will reach final consumers and also buy and supply intermediate goods to other firms. So a firm can be either a buyer or supplier in terms of intermediate trade. But final consumer trade is going to be kind of boring because you're just going to sell locally. And firms are going to be heterogeneous in this measure of productivity C, which is going to follow an exogenous distribution that's going to be heterogeneous across locations. In terms of production, the unit cost of production by a firm omega in location I is going to be given by the sort of inverse of the productivity of the firm and the Cobb-Douglas aggregation of costs, which is going to take labor costs and also intermediate input costs, where this P is going to be the price that a supplier B is going to charge to a buyer omega, and sigma is going to be the substitution across different inputs, and this big omega I is going to be the set of varieties that omega has access to, and that's the key object that we're going to endogenize through search and matching. So there's going to be supplier and buyer postings between each pair of locations. They're going to be randomly matched following a standard DMP type of matching technology. So how is this going to work? And this is sort of the most important block of the model. So firm, imagine you have three locations, location I that has an upstream location and a downstream location. Firms will post ads for both suppliers and buyers across locations. So these are going to be NS and NB, depending on whether you're posting ads for suppliers or buyers. And these ads will be sort of location pair specific, and also productivity. They're going to vary with productivity of the firm. So you're going to be posting ads from standpoint of location I. You're going to be posting ads to reach buyers, say downstream, and suppliers upstream. And the way it's going to work is going to be similar to following sort of Costa's Your Market paper, and also more recent work by the Midfielder Yu and Yang, sort of in terms of how firms match with each other. But then given those ads, there's going to be random matching by location pair for both suppliers and buyers following a DMP type of matching technology. And that's going to determine the matching rates that you can have at each bilateral level of locations. Yeah.
So firms post in all locations, or they select the location where they post?
I mean, that's something endogenous, but in practice, with the way we wrote it down, they post everywhere.
But there is a fixed cost of posting that location, right? For now.
Let me tell you about a moment, but obviously one feature, I mean, we're going to work with a continuum. So one feature that we're not going to be able to hit very well is the fact that, you don't see firms with links everywhere. So that's something in the data that obviously happens. We're not going to hit that with our model, because the model here, we're going to have a continuum and firms are basically posting everywhere and having some links everywhere. Good one. So given that matching, the supplier is going to determine prices and buyers are going to determine how much quantity to purchase. It's going to be monopolistic competition and therefore a constant markup above the marginal cost of the supplier. And then on the final demand, as I said, that's going to be a bit less interesting in the sense that we're just going to say that these firms are selling locally. They're going to post also ads, but they're all going to turn into successful matches. So there's no friction in the local final demand market. And basically, we're not doing that very interesting because we don't have data on that market. Okay, so a little bit of the math here. So if you solve first for how much labor you want to have, and then you maximize profits by choosing the number of ads you're going to post both for suppliers, for buyers, and for final demand. You're going to get profits from consumers. You're going to get profits from intermediate buyers, and you're going to have a search cost. So the search cost is going to have a shifter F. It's going to shift how much you're going to pay for posting ads. But then there's also going to be some curvature here. So gamma is going to be the parameter that governs the curvature of how much costs increase when you increase ads, the number of ads you want to post. And that's going to be subject to the technology that you have. So you can see here that the key objects
besides the ones that you want to choose, are going to be these endogenous matching functions that are going to affect the rate of reaching buyers and the rate of reaching suppliers. So if you reach more buyers, that's going to be good in terms of revenues. If you reach more suppliers, that's going to be good in terms of cost. You're going to be able to reduce your cost and get more buyers. And so the key parameters, exogenous parameters, are going to be these shifters, these cost shifters, and the convex cost parameters in terms of posting ads. The solution to this problem is going to give you something like this. The number of ads that you're going to post is going to be a function of a bilateral A shifter and C, which is the productivity of the firm up to this parameter. So, and this A's, bilateral A's are going to depend on the cost shifters that I told you before, the demand shifters, and the matching rates that are going to be endogenous. So here you can already see something that I mentioned in the first slide, that the number of links, so this is going to be sort of related to the number of links that the firm has, is going to be related to both the geography of the firm, so that's where the firm is, that's going to affect the A's, and it's also going to be related to firm size through the productivity of the firm. So you can sort of rewrite this relationship so that on the left-hand side you have the number of links, and on the right-hand side you have sales, and then you can sort of map this directly to the relationship, the correlation I showed you at the beginning. Okay, but this is going to sort of map directly to the fact that I showed in fact 1. So given that, you're going to aggregate, you're going to go to the aggregate, and so the matching between buyer suppliers is going to follow this Cobb-Douglas function. You're going to take the number of ads that are posted between a pair of locations, UD, for suppliers, and the same ads posted for buyers, and sort of with this Cobb-Douglas function, you're going to get the total number of matches that you have between 2 pairs of locations. Okay, so the key parameters here will be a kappa, which is going to be the shifter, the efficiency shifter of the matching technology, and then lambda S and lambda B, which are going to be the elasticities of how many links effectively you get when you post one marginal ad. And given this, you're basically done. You can get the matching probability, the intensity, by just dividing the effective number of links that are created relative to the total mass of ads that you posted. Given this, you can get nice gravity equations of bilateral trade flows, both for the total number of successful relationships, that is the extensive margin, and the transaction volume per relationship, that is the intensive margin. So for these 2 cases, you can sort of write down these 2 objects as a function of bilateral resistant components, UD origin components, and destination components. So the bilateral component of the extensive margin is going to be a combination of the matching friction, so the matching efficiency shifter. It's going to be a function also of the shifters of posting ads, and also a function of the trade cost, the iceberg trade cost. Whereas the intensive margin, the bilateral resistant component of the intensive margin, is just going to be a function of the iceberg trade cost. So here you can already sort of go back to the fact that I showed at the beginning, that if you remember, there was a different sort of decay of the extensive and the intensive margin relative to distance. So you can get something, rationalize something like this with this result, where the exponent on tau for the intensive margin, the bilateral component of the intensive margin is just going to be 1 minus sigma, whereas for the extensive margin, it's going to be 1 minus sigma over 1 minus lambda tilde S and lambda tilde B. And the key thing here is that what's going to matter are going to be these lambda tildes, not the lambdas original. And the lambda tildes is just going to be the fraction, the ratio between the original lambdas, that are the Cobb-Douglas weight of the matching technology, and the gammas, which is the slope of the cost of posting ads. So the ratio of those 2 parameters will give you the gamma, the lambda tilde, and those will be the key parameters in determining the slope between the extensive margin and the iceberg trade cost. So here you can already sort of predict that you will get amplification effects from this endogenous network, because the trade elasticity is no longer going to be 1 minus sigma, it's going to be 1 minus sigma over 1 minus lambda tilde and minus lambda tilde B. And if these things are positive, then you're going to get amplification. It's going to be larger than 1 minus sigma. I'll go back to this later on. But the important part here is that we're going to connect this directly with fact 2, and the way to rationalize that is that we can already sort of see here that these lambdas have to be positive in order for the slope that I was showing you before to be different between the extensive margin and the intensive margin. Okay, so let's go to aggregation. Yeah.
Can you repeat again the prices, how they are determined? Because you said that there is a constant markup, but I don't understand exactly how the matching technology leads to a constant markup, because you may have an on-site option or not.
Yeah, so that part of the model is going to be kind of simple. You can think of more sophisticated ways, but the way it's going to work is that you first are going to have the posting of the ads. You're going to have the matching, endogenous matching outcome in terms of which links you're going to get. And then given the link that you get, you're going to have monopolistic competition with a continuum. So then, the price is going to be determined by the constant markup, and then the quantities of the buyer are going to be determined by the demand function that the buyer has.
So you have access to a continuum of suppliers of the same variety. Is that what's going on?
I mean, you're going to have, these are going to be different varieties, but yeah, you're going to have a continuum, you're going to be a residual, you're going to be a residual supplier of a particular good, and that's going to give you monopolistic markups. But it's going to be constant given. But yeah, you can think of more sophisticated bargaining schemes. But we're going to take it very simple here. We're not going to go very sophisticated in terms of pricing in this version.
So basically, the measure of varieties is endogenous, right? Within each firm. The measure of
the set of buyers that you're going to have.
Yes.
Yeah, that's going to be endogenous. The number of links that's going to be endogenous, and that's going to be a combination of the number of firms that are posting ads and the matching rate. That is the endogenous outcome.
The fact that you use CES with monopolistic competition basically makes the model more tractable, because otherwise.
And also that we have the continuum. So the two things are important: the monopolistic competition and the continuum.
Sorry, but for the constant markup, the size of the continuum doesn't matter, the mass, right?
Yeah, no.
Just elasticity or substitution.
Yeah. Okay, so in terms of aggregation, the general equilibrium is going to be determined by the following set of equilibrium conditions. You're going to have the search intensities that I showed you before. They're going to pin down these A shifters. The gravity equations that I mentioned before, that are going to be pinning down the extensive and the intensive margin. The firm free entry, didn't talk about this, but you're going to have in each location a standard entry condition. So it's like just a Melitz type of entry condition that's going to determine the mass of firms in each location. You're going to have trade balance, and then you're also going to determine the trade, the cost shifters and the demand shifters from the usual accounting relationship. So we can show that the equilibrium is characterized by two fixed points of wages and cost shifters. And this is going to be related to a buyer axis and a supplier axis component. So the buyer axis is going to come from the feature that, labor compensation is going to be a fraction of total revenues, and that's going to help you to determine wages. But the nice feature here is that, wages are going to be a function, this is going to be exogenous, so wages is going to be a function of total trade flows that you get from buyers. But that is going to be a function itself of the full list of wages and C star, which is going to be the cost shifters, for two reasons. One is because of the matching that's going to relate different locations between one another, and second, the production level. So those two features will make all these things interdependent. So you get that on the buyer axis, but then on the supplier axis, the logic is kind of similar. Your cost shifters at the location level is going to be a function of your total cost, but that's going to be a function itself on the total trade flows that you have with suppliers. But again, the total trade flows with suppliers is going to be a function of the full vector of wages and C stars because of the matching technology and the production network, and that's going to make all this sort of recursive. So this is going to sort of follow a similar structure to previous literature, but the key thing is that it's going to incorporate the endogenous search and matching that's going to affect the extensive margin. And that in turn is going to affect the flows, and that in turn is going to affect the total cost and the wages of each location. So you can rewrite these two system of equations, and it's going to give you the following. You can see here. Let me just highlight a couple of things. First of all, this KD and KU will be a combination of exogenous parameters, including the bilateral frictions and the extensive and the intensive margin, the ones that I mentioned before. Second, what's going to be important again is going to be the lambda tilde, which is the fraction again of the lambdas of the Cobb-Douglas matching function and the gammas of the cost function of posting ads. Third, if you go down to the world, if you go back to a world in which there's no endogenous extensive margin, so lambda is equal to 0, lambda s and lambda b is equal to 0, and therefore lambda tilde b and lambda tilde s are equal to 0, you're back to a world in which the links are exogenous. Then you're going to go back to the standard gravity trade models with roundabout production, you know, you're going to go back to Galindo Barro, Alvarez Lucas, and so on. So that's going to be kind of a nice thing. You just move around this one parameter and you're going to include this feature of the model that we want to highlight. Fourth, we can prove uniqueness condition following sort of previous spatial model sort of techniques, and also do your usual hack algebra counterfactuals that will give you sort of nice expression of how to compute counterfactuals in this world.
So I guess this way of characterizing the equilibrium is similar to the other Kostas paper.
Yeah, it's basically, I mean, Allen Alkolakis is basically the same structure. Yeah.
So basically, you're saying you can map a network model to a universal gravity frame.
Yeah. Yes, and yeah, you move around this parameter, and that's going to be enough to go to the standard models to the model that we have.
Isn't that saying that if you have a network or not, basically at the end of the day, it doesn't matter? It's like the ACR results, the model.
Well, I'm going to show you this in a second, actually. Yes, this is, I mean, that's a good direction. Okay, so here we have it actually. So you can show that welfare for each location, so the real wage is going to be proportional to the own import share changes. So this is the usual sort of component of ACR. It's going to be the elasticity is going to be a function of sigma and beta, given that we have intermediate trade. But then also what's going to matter is the changes in the domestic linkages that you have within your own location. So again, if you go back to a world in which, you know, this endogeneity of the extensive margin doesn't matter, so lambda tildes are equal to 0, then m tilde is not going to change, it's going to be equal to 1, and then you're back to gravity trade models and ACR typical footprint. So this is telling you that once you allow for this margin of decision, the predictions of welfare changes to a particular counterfactual is going to be different. And we're going to quantify how big of a deal this is. But it's very clean in the sense that, you know, we can sort of see where it's coming from. And you can also open this up and show sort of where that's coming from in itself. And then also the second thing you can do is look at world welfare and see how changes in world welfare are going to be sort of to a first order approximated by the direct technology effect and also some reallocation effect. So this is sort of following Baki and Fadi's work, or similar to Orkins and Bernstein, showing that if you shock with a technology trade shock in this world, you're going to get departures from, say, Houghton type of prediction, in which the technology effect is not going to be sufficient. You're also going to have to take care of, even to a first order, take care of reallocation effects that are going to come from this endogenous network effect. So the way that the number of links between locations changes is going to affect, for first order, the welfare effect of a particular trade shock. And the nice thing here is that this is sort of very directly from Baki and Fadi's work, while showing you that the reallocation component is coming directly from how the production network responds to shocks. And again, we're going to show you how big of a deal this is. Okay, and then we're working on extensions. We have multiple sectors. This is kind of important because when you think about the geography, especially as a country of Chile, like Chile, you have to think about, you know, natural resources in the north, there are copper in the south, you have, you know, fish and forestry, and, you know, you have to take those things into account when you want to think about differences in terms of number of links that firms have, and we're doing that, sort of allowing for that in the data and kind of extending the model to have multiple sectors. It's not a big deal. And then also you can extend it to a population mobility that would just give you another variable in this system. So besides wages and the cost shifter, you will need to solve for population. And you have just another equation in that system characterizing population. But that's about it. Okay, so let's go to the quantitative analysis. We're going to calibrate the model with 345 municipalities. So these are the ones that we see in Chile and all foreign countries. We're going to exactly match bilateral trade flows. So that's just sort of inverting the model. We can just match it directly with the model. We're going to use for this the domestic firm-to-firm transaction data and the customs data. We're going to calibrate the labor share in production, which is going to be 0.2 according to our data. And then we're going to estimate these three remaining key elasticities, lambda tilde B, lambda tilde S, and sigma. We're going to do indirect inference targeting the response of the input shock that I showed you in fact 3 at the beginning. We're going to impose that these two are equal to one another. We don't have at this moment facts or moments to kind of identify these two things separately, but that's something we're working on. And we're going to impose the sufficient condition whenever we solve for equilibrium. Okay, we're gonna impose the sufficient condition for uniqueness. That's going to limit a bit the space in which we want to search for parameters that map into this fact. We do a spatial friction decomposition. Actually, I think we have some time to talk about that. So we have 20 minutes, no? 25 minutes?
20 minutes.
20 minutes? Yeah. So let me show you this. So we can decompose the bilateral trade frictions into surge frictions and iceberg costs. So we can sort of infer from the model and the data the surge component of bilateral frictions and the iceberg component of bilateral frictions, and we're going to use the intensive and extensive margin of these flows to estimate the trade cost relative to within location trade. So this is basically head and wheels. And we're going to estimate these for all pairs of municipalities in Chile, and we're going to get these measures of iceberg bilateral costs and search and matching bilateral costs. This is the way we measure it. It's just following head and wheels. And what we find with this is that if you project the iceberg bilateral frictions and the search and matching bilateral frictions with distance, you'll find something similar to what we had before. Search and matching costs are relatively more sensitive to geographic distance than physical iceberg costs. And again, this is coming from the feature of the model that the elasticity of the extensive margin to these iceberg trade costs is just different than the elasticity to the iceberg trade costs in the intensive margin. And this is going to be consistent with recent literature on search and matching frictions in trade that kind of highlight that these frictions are very important, and in this case sort of showing you that relative to geography it's even more important than the iceberg trade cost.
The iceberg, we should understand that as a physical,
right? And
the search and matching is the fact that you cannot. It's harder to find part from the farther you look.
Yeah. But this is like it's like a compound of the matching efficiency, the cost shifter of the posting ads, and so on. We don't have at this point any data to kind of show you which component is more important. It's just a bundle of frictions for search and matching.
I would, if I had to guess before seeing the model, I would imagine the search and matching cost or the elasticity is lower than the iceberg, just because
the elasticity with respect
the 630. So you're amplifying the output, right? I would have thought that is the opposite. Like you can search through other medium. You don't need to be physically. But that's simply intuition. It's just I understand how the model works.
Yeah.
There is something in the model that is there something in the model you think it's generating that, or is my intuition not good?
Yeah. No, I mean the sort of mechanic answer is that this is driven by this amplification effect that I was talking about before. But in terms of the micro foundation of why that result is holding like that is because of what I was saying, that this is a bundle of different things. And we don't know whether this is responding because of the matching efficiency that sort of varies a lot with distance, or the shifters of posting ads. So we don't know whether it's coming from the search or from the matching part of the model. But you might think that it's easier, like to kind of, given the technologies that you have these days, it's easier to look online for someone and then match rather than shipping.
I was wondering what in the model might be generating that, but
maybe it's just as easy. Yeah, I mean, again, the model doesn't have anything to say about that because this is just a bundle of things, it's a black box. But yeah, on the other hand, you have something that you can sort of get the phone number of a supplier on the website, but then you need to meet the guy, and then you need to build a relationship, and then you sort of need to maybe adapt the input to your product. So maybe all those things will sort of affect. Distance might be important there, right? But yeah, this is an open question. I think that's interesting to think about. Okay, so let me show you some numbers. So here, the first column is showing you the baseline estimate. So I already told you about the 0.2, that's sort of the calibration of beta. We get sigma to be equal to 3.07, and this lambda tilde to be equal to 0.17. In terms of how well the indirect inference procedure works, here on the first row I have the data. On the second row I have here the model prediction under the baseline case. So here, I mean, this is obviously these are targeted moments, but sort of the procedure works relatively well. And what we do is that we also re-estimate the model in the case in which there's no extensive margin adjustment. So that's going to be our sort of comparison case. In that case, by definition, lambda tildes are going to be equal to 0, and we re-estimate the model, and we get a sigma that is a little bit smaller. So it's going to be 2.15. And we're going to compare the results in that particular counterfactual. And obviously, here what we're doing is that we're matching the moments of how total flows change while ignoring how much the number of links change. So that's, that's going to be 0 by construction. So everything is sort of loaded into the intensive margin. So obviously the intensive margin is going to be off relative to the data because we have to adjust that entirely to match changes in the total trade flows. Okay, so we're going to do two counterfactual simulations. We're going to do the international trade shock. We're going to affect some shocks on global value chains connected to Chile from different countries, and also a domestic transportation infrastructure shock that's going to be an effect of building a mega bridge to the island of Chiloé, which is in the south of Chile. And we're going to run two scenarios for both counterfactuals. The baseline, as I told you, is going to be the full estimated model with lambda tilde equal to 0.17, and then the non-endogenous response of the extensive margin where lambda tilde is going to be equal to 0, and then we're going to try different values for sigma to see how sigma matters for the predictions under that alternative model. And again, the overall intuition is kind of simple in the sense that the overall trade elasticity with the endogenous network is going to be equal to this, which is what I told you before. So whenever this is positive, you're going to get amplification. In a world in which you don't have the endogenous adjustment of the extensive margin, this is going to be equal to 0, and then the trade elasticity is just going to be 1 minus sigma. It's going to be the usual thing. But if this is positive, then that's going to be even larger than 1 minus sigma, and I'm just going to show you how big of a deal those numbers are. Okay, so these are some numbers. We're going to think about a 10% reduction on iceberg trade costs from or to China. So we're going to think both export and import effects. Germany and the US, we're going to think of this as different counterfactuals. We're going to shock first China, we're going to shock then Germany and then US and see the different effects of that on welfare in different locations in Chile. Here I'm showing you the income-weighted welfare changes across locations in Chile to these counterfactuals. So for example, in the baseline model, we'll see that a reduction, 10% reduction in export trade costs is going to increase welfare from this shock to China. It's going to increase welfare by 1.5%, average welfare across locations. With Germany, it's going to be 0.24, and with the US, it's going to be 1.4. It's relatively bigger for China because the trade share with China is larger than with the US, for example. China is a very important trade partner of Chile. But what's important for us is that if you go to the case in which there's no extensive margin with the same sigma, so you don't re-estimate sigma, you're going to get a welfare gains that are significantly smaller than the baseline model. So this is sort of the baseline amplification effect that's coming just because of allowing for the endogenous network to respond to the shock. So the extensive margin is going to respond, it's going to expand when we have these positive trade shocks, and that's going to amplify the welfare gains from the shocks.
But then you might say something like, okay, but this alternative model without the lambdas or with the same sigma is kind of, unfair because you're not allowing this model to be able to replicate the same micro patterns without the endogenous extensive margin, right? So then you re-estimate the model without the extensive margin adjustment, and you're gonna get a sigma that is even smaller. This is what I showed you before. But then it's gonna go in the opposite direction. You're actually gonna get a bigger amplification relative to the baseline model. But then you might say something different. You say, oh, but that's not the relevant moment you should sort of rethink about. You should think about the model, the moment that sort of generates the same changes in lambda II, which is the relevant object that goes into the welfare ACR formula. So if you take the lambda AI from the baseline model and plug it into the model that doesn't have the extensive adjustment, and you're going to need a sigma of 5 to be able to replicate this lambda AI with no extensive margin. Lambda AI is the own trade share. So it's the trade share that you have with yourself that goes into the formula, the ACR formula. So you can, in the model with no extensive margin, if you plug in a sigma of 5, you're going to generate the same changes in lambda AI as in the baseline model. So that's going to be kind of a more fair comparison in the aggregate because they're sort of generating the same input change. I mean, the trade flows changes. We just want to see how that affects welfare. And with this higher sigma, it's true that the amplification is a bit smaller, but it's still significantly large. So roughly a third of the welfare gains are amplified, are due to the amplification. And if you do this across countries, there's a lot of heterogeneity. We've been thinking about how shocks to different countries have different welfare effects depending on where the country trades with the supply chain in Chile, the domestic supply chain. So if you have a country that is trading more upstream, sort of raw products, that's going to have a different effect than a country that is trading more final goods. So the ones that are trading more upstream goods can have sort of a bigger ripple effect domestically. And we're sort of exploiting that heterogeneity in terms of shocks across countries. And you do see a pattern there, but this is something very preliminary yet. But what we want to claim with this is that there's a new gains from new varieties effect that has been sort of pointed out in the literature before, in particular Gobinat and Niemann, but here we're sort of pushing it more to think about domestic firm-to-firm linkages and not only linkages with final consumers. So sort of extending this idea to think about how these linkages respond to shock and how that amplifies the welfare gains function. Let me finish with some distributional effects. So here I'm showing you these welfare effects across locations. X-axis is the direct international trade exposure. So this is the import plus export share exposure that each location has with China. And the blue circles are going to be the welfare gains from this shock across locations. And the green squares are going to be the same welfare effects, but in the case in the model without extensive margin adjustment. So first of all, you can see that there's a positive correlation between the international trade exposure and the welfare gains. Obviously, if you're more exposed to these shocks, you're going to get a bigger effect. But there's a lot of heterogeneity. I show you that the average effect was like 1.5. Here the units are different, but this is like 6% increase. So some location, this is actually a big central location, Santiago, it's going to increase 6%. And other locations are going to increase much less. So there's a lot of heterogeneity in terms of who is gaining from these shocks. And then also what's important is that if you shut down the extensive margin adjustment, that's going to shift the slope of this relationship quite substantially. And this is sort of what I showed you in the previous table. This is using the sigma equal to 2.15, which is the value that was re-estimated with the microdata. And obviously, if you use a sigma equal to 5, it's going to be a bit closer to the slope of the baseline model. And also note this is not very clear here, but there are many regions that the intercept is sort of positive. So locations that actually don't have any exposure with international trade, but do get a positive effect on welfare. So that's just because of the production network feature of the model. So even if you're not directly exposed to trade, you can still benefit from trade because you're related to other regions that trade themselves. And if you do this across country, you're going to get similar patterns, but there's a lot of heterogeneity that we are exploiting, plus sort of this sectoral heterogeneity
as well. So now sort of exploring the multi-sector and multi-country version of the model is what we're working actually these days.
Sorry, the squares and circles were referred to the first, one of the first slides, and I don't remember whether it was the size of the firm or the.
No, so here the size of each circle or square is given by population. It's just a measure of how big these locations are, but this is not just showing something different. It's just showing the welfare effects of the shock. Okay, let me finish there. Like 1 more minute to go. So, yeah, we analyze the organization of endogenous production network in space. We develop a micro-founded model of firm search and matching, and show both aggregation, both positive and normative properties, and apply the model to firms' domestic and foreign transaction data from Chile, and study how the China shock affects different regions in Chile when the production network is endogenous, and show quantitatively that allowing for this network to be endogenous is important both in the data and also quantitatively if you go to a model that sort of allows for this feature to be happening. And you know, today I just focus on the domestic sort of version of this firm-to-firm trade, but there's no reason to think that this is just a domestic feature. You can extend this approach to think about international production networks, sort of global value chains across countries. If you were to have the data, and you can do the same thing and just apply the same sort of strategies. And you know, the nice thing about the model is that it's very tractable, so you can scale it up almost as much as you want. Okay, any question?
Well, thank you.
Thanks.
Sí. No, el número de firmas va a cambiar. El número de firmas puede cambiar porque entonces el número de firmas puede cambiar. Lo que no tenemos es que no tenemos como que una firma se cambie de ubicación. El número de firmas que entran cada ubicación es lo mismo. Pero el número de firmas cambia lógicamente.
Bueno, me gusta que se matea bien con el. Está pensando en la matriz
pero igual tiene la matriz,
pero en la teoría.
La teoría también está.
Pero es una matriz, ¿cómo definir firma?
No, puede definir la matriz bilateral entre locations.
Entre locations, exacto. Lo que firma no hay matriz.
Claro, el modelo no, porque hay cortina.
Exacto, sí, eso es. Y cuando vos perturbás el modelo, la network no se vuelve, no se optimiza.
No, la gracia es que
para un fixo para un link. Ese link de sorpresa, ¿no? Yo te hice un shock. Todavía puedo usar, quizás no hubiese armado el link que tenés corriente. Pero dado que tenés que armar un fixo, si puedes usar famoso, seguís usando el link anterior hasta que se depresa. Finalmente eso,
no, eso es como un modelo de matemáticas. De eso estamos trabajando ahora.
Eso no es complicado.
Sí, depende cómo lo hagas. Pero si piensas que hay un poquito más de arrival de link, claro, depende de cuánto sea sofisticado hacer el dinámico. Estamos ahora, bueno, estamos metiendo todo sector.
Sí. Una pregunta más. Vos tenés mostraste una cuestión de cambio
vice versa, trade calls. Digamos, entonces,
Sí, sí, sí. Es como el C.
Claro, que ese tiene
Claro, o sea, tienes el technology effect, que viene dado por el impacto directo del shock, condicional en todo, y tienes el relocation effect, que es como ya estaba montado en el
tienes una medida de estudiante, podrías calcular.
No, pero estos son los weights, son los dos.
Ah, ok.
Share spending, nominal word to be. Esto es súper fácil, de medir.
Yo tengo una medida de cómo el COVID afectó esto y veo esto. Bueno, si se me ocurre algo, te digo.
No, y lo que uno puede hacer es como escribir de shocks que sean la movilidad.
Claro, exacto. Nosotros observamos esto, pero con el modelo simple que tenemos, podemos deducirlo porque es proporcional a la movilidad. Bueno, voy a pensar más.
No, buenísimo, encantado.
Gracias.
De hecho, nada que ver.
Pero
no.
No importa, pero. Sí, eso, bueno, eso.
bueno, mañana. Dale.
Nos vemos. Hasta mañana. Chao.
El último es que la gente ya ha terminado.
Sí, vamos a hacerlo peor.
Yo porque a la mañana me apagué porque no entiendo nada de lo que pasa. Entonces me quedó el resto para la tarde.
¿YouTube ya lo cortaron? ¿YouTube ya cortaron la transmisión? Deciste que ya. No, no. Sacamos las botellas. ¿De qué? Ahorita van a hacer ahí todavía. Ay, qué lindo. Dale, venir, yo sé que querés venir.
Yo me miré. Me miré de todos los perfiles.
Yo, ¿por qué todo aquel lado? Si yo me estoy pegando para este lado, está al revés.
Me muero si esa camarita graba.
Ah, ya está, ya me está.
Ahí, más ajustado. ¡Salimos en la tele! ¿Sabor?
Okay. Sí. Ah, vos sos el chico que nos limpia todos los días. Ay, gracias. Siento ser un chiquero. ¿Sí? Ay, no, ahí le dije que podemos hacer. Yo.
La tijera.
Ahora, pero yo no tengo.
¿De cuál? ¿De Litela?
Litela.
Ya tengo. Me la dio vuelta. Ahora sí asumo, ¿no?
Me parece la cara de Cecilia.
¿Qué hacer? Está buena la cámara, ¿no? Nada. Nada. Ahora yo tengo que tirar esto de la... Tengo que tirar esto a la basura.
En el informe.